Mostly ladies. We're going to start. So please take your seats. Some people are still in the corridor, I think, yes. Great, so welcome back to day 2 after a fantastic dinner last night. And for some of us, a walk and a run this morning. We are now fully energized for the new papers of the day. And we are starting with Özge, who is going to discuss global spillovers. So Özge, the floor is yours.
So thanks a lot for having me in the program. This is a joint work with Şebnem Kalemli Özcan from University of Maryland and Albert Caralto from the Federal Reserve Board. The usual disclaimer applies for me and Albert. Our motivation in this paper is that risk sentiment has been shown to have large footprint in global macro finance developments. So in this figure, there's 3 panels, and in all these panels, I'm going to be showing you the volatility index, VIX, black line. The panel on the left is showing the correlation vis-a-vis the credit spreads in the US, advanced countries, and emerging markets. The middle panel is showing the correlation of VIX along with the dollar exchange rate vis-a-vis the emerging market currencies. And the last figure is showing the correlation of VIX with the UIP risk premia. So what we know from the literature, there's vast literature in global financial cycle facts. We all know by the influential work led by Helen that increase in uncertainty is associated with lower global risk asset prices. That's what we see also from the first panel. Lower emerging market exchange rate vis-a-vis the US dollar, and also is associated with higher UIP premia and capital outflows from emerging market currencies or emerging markets. So what is our contribution? So there is vast empirical literature. We know this global financial cycle facts. What we want to do in this paper is to come up with a mechanism, a framework that can generate all these facts in a single framework. And we are going to be also providing evidence on the mechanism of the model. So the key elements of the framework that I'm going to be presenting today are threefold. The first is that there is going to be a financial intermediary at the core. So these are US-based financial intermediaries, but as I will argue, they will be acting as a global intermediary. They are holding assets across the globe. But importantly, these global intermediaries are long-lived and financially constrained. The third feature that I'm going to be incorporating in the model is that there is uncertainty shocks. So it's in the high order shock in the tradition of Bloom and Basebundik, and these uncertainty shocks are going to lead to endogenous fluctuations in the risk premia. So as I go through my presentation, I'll make sure why we need these long-lived financial intermediaries, and I'll go back to the standard model and make reference how we are different from the standard model. And we also need uncertainty shocks to generate all this co-movement with the first order shock. I might not have time, but in the paper we argue that with the standard first order shock, you will not get all these co-movements right. And you cannot generate increase in uncertainty. So let me give you a preview of my findings. So I'm going to show that there is going to be large effects of uncertainty shocks coming from the intermediaries' balance sheet constraints. And intermediaries in this framework is going to act as if they are highly risk averse because of their leverage constraint. So the second important feature or finding is that once they are faced with more uncertain future prospects on their holdings of risky asset, they will be facing deleveraging pressure. And this deleveraging pressure is going to generate, through the optimal portfolio condition of the intermediary, a tight link between the home and foreign asset prices, and also the link between the dollar, like the value of the dollar vis-a-vis the foreign currencies. So overall, seeing when the intermediaries see the more uncertain future asset returns, they will be deleveraging, because despite that they have uncorrelated dividends of home and the foreign assets, we see the asset prices fall, risk premium rising, dollar appreciating, and there's capital outflows from the emerging markets. And you will not get the same facts, these empirical facts, in the standard model, as I will be showing. Okay, so this is the outline of my presentation. So I will be starting with the motivational evidence. Later, I will spend most of my time talking about the framework. This model is a two-country model. So I'll be thinking about US and emerging markets. And it's a two-good real economy. There's going to be differentiated goods, home and foreign. And I'm going to show the effects of US-based uncertainty shocks on the asset values and risk premia, and also on the UIP premia and the capital flows. And I'm gonna, the last few minutes, if I have time, I'll be talking about the more detailed empirical evidence in favor of the model mechanism using the panel data. Okay, the first, motivational evidence, because we are really thinking about that one needs the global banks, and the global banks' network position is important in determining asset prices across the globe, including when I talk about asset price, I have in mind also the exchange rate. So the figure on the left here shows the correlation of the asset VIX volatility index along with the evolution of the net worth. And here I compute net worth as the asset minus liabilities of the US chartered depository institutions. The figure on the right is showing the evolution of these US financial intermediaries' net worth along with the emerging market corporate bond spreads. So the figure shows both, net worth is highly correlated with the volatility index. Net worth is also highly correlated with the corporate spreads in emerging markets. So I put them in the panel framework. So the regression is that I regress change in the credit spreads, corporate credit spreads in emerging markets on the volatility index, net worth of the US depository institutions in the previous period. And I also interacted it with the volatility index with the net worth. So I'm gonna pay attention to the result in the square bracket. And what is this table is showing. So as you expect, when the volatility is higher, so I'm seeing the credit spreads in emerging markets are higher. But at the same time, if the banker is not very well capitalized, I see that credit spreads is also high in emerging markets. But importantly, when we interact these two, so if the banker is the global banks or the US banks is not very well capitalized, so this means that it is more likely for these bankers to be credit constraints. So if they are less capitalized, given change in the, so the same change in the volatility will have much larger effect. So we see 50 basis point more increase in the credit spreads in emerging markets when we have the net worth in the previous period is low. So this is giving me some motivational evidence that the banker's net worth might be behind or is an important factor in amplifying and also in transmitting the shock across the globe. So this is the model. So I'm going to be talking about the model which is not a production economy. It is the simplest possible model that I think you can think of. It is in the tradition of consumption-based asset pricing literature, but I'll have one tweak, as I said, which is the banker. So this is two countries. I'm going to be thinking about home and the foreign. Foreign is the emerging market. Two goods, and because this is a real model, as I said, I want to make the model as simple as possible. So it is a real model where there is two differentiated goods. So I can introduce a role for exchange rate. There is home produce and the foreign goods, and this is the CES aggregator. What the households are doing here is that they are going to be saving via deposits in intermediary in their own country. So the banker is going to be collecting deposits from households. Utility of the households are CRRA utility. With one row, here is the risk aversion parameter. So that I'm going to make reference to one row because this is an important parameter determining the size of the risk premium in the CAPM model. So household budget constraint is standard. Solving the household problem will give rise to the household optimality condition, which is that expected, marginal utility is given by the standard term. Again, here, one row is the household's degree of risk aversion or their stochastic discount factor, and the R is the safe interest rate. So in this framework, I'm going to be introducing these home intermediaries. So there is a banker in the US, and this intermediary is going to trade claims on both local and foreign tree. Again, this is an exchange economy. There are trees. So I can hold, the US intermediary can hold a tree, a claim on both the local US tree and the foreign tree. But they are going to be facing constraint that I am going to show. The capital productivity at home, Z, is totally uncorrelated from the foreign. This is important. I'm not going to get co-movement because they are correlated. So they are totally uncorrelated. And the productivity is following an AR1 process. Importantly, the volatility is going to be time varying. So let me go to banker problem because that is the, I think, most important agent in the framework that we are going to be proposing. So I think for simplicity, I'm going to go in steps. The very first step is that I'll be talking about the banker problem as if they are in autarky. They can only hold assets or hold claims for the domestic tree. What they are doing, the banker is collecting deposits from households, and they are going to be investing in tree at home. But after they collect the deposit, they can run away with the fraction of the deposits or fraction of their assets or claims. So in cognition of this possibility, as in Gertler and Kiyotaki framework, there's going to be a constraint, the incentive compatibility constraint. So the banker who dies, there's a banker who dies every period with a 1 minus sigma probability. They are going to be distributing retained earnings to households. They are owned by the households. And this is the continuation value of the banker. And this is the evolution of the network. But importantly, the continuation value of the banker cannot be higher than the theta fraction. So I'm going to guess that the value function is linear. I'll rewrite the maximization problem of the banker subject to the incentive compatibility constraint, which can be written as a leverage constraint. So assets divided by net worth is the leverage. It has to be less than or equal to the maximum leverage that the banker can have. But importantly, in Gertler and Kiyotaki framework, this maximum leverage is endogenous. So here it is the theta is the financial friction, expected excess return on your holding of the on net worth, but there is this term which is the mu, and mu is the expected excess return on holding risky assets. Another important thing here is that now in the maximization problem, the banker's stochastic discount factor, under the condition that they are constrained, is augmenting the household stochastic discount factor by a term. And as I will show, this term is highly countercyclical. So in bad times, they are more risk averse compared to the households. So if you rewrite the banker's problem, when the constraint is binding and imposing the market clearing condition, asset prices in the economy now is going to be determined by the leverage cap times the net worth. Again, the mu is the expected excess return on holding domestic tree, and the stochastic discount factor now is augmented by the marginal value of the intermediary net worth. So in bad times, when your net worth is low, intermediary, every unit of net worth is worth more to the intermediary, right? So this term makes the stochastic discount factor very volatile and counterfactual, countercyclical. So how the uncertainty shocks transmit in this world? So again, we are still in autarky. And if you think about your standard CEPR model, you will get these two equations. The first one is what I showed you before, right? Which is the household's Euler equation. And the second equation is the standard capital Euler equation. So in this framework, if uncertainty rises, so there is more uncertainty in terms of how many trees I'll be getting from, how many fruits I'll be getting from my tree tomorrow. So in this environment, and I'm not constrained as a banker, right? So in that framework, because of the precautionary saving motive, everyone wants to hold the safe asset. So what happens in this framework, the return on safe asset has to fall. And asset prices, given in the second equation, go up. So the model predicts, the standard model predicts high uncertainty is associated with high asset prices. But in our framework, with intermediary frictions, now asset prices is determined by the leverage cap. Leverage cap is now endogenous times by net worth. So when uncertainty shock hits, right? So now it's again not certain how many trees I'll be getting. So this is then associated with mu going down. So if I'm uncertain about my prospects for my risky assets, expected excess return on holding the risky asset is gonna go down. So the lower mu is gonna reduce the leverage cap. So that every intermediary, so every single one is gonna be facing lower leverage cap, meaning that they have to delever. If everyone is doing the same, asset prices has to go down. So this is gonna be explaining why asset prices in this world is moving the way that is consistent with the empirical evidence. But again, the stochastic discount factor, because now it is highly countercyclical, it also generates large effects. So this is the figure just because, so I spend a lot of time here because this really explain why in this framework or why we think that the banker network or the global bank is important in generating the call moment. So higher volatility, again, is going to be generating lower asset prices, lower net worth, and higher risk premium. So the second is I open up the economy. So when you open up the economy, what happens is that there is another first order condition. I show you the Q is determined by the leverage cap. There is another first order condition because now the banker is choosing not only domestic assets, but also foreign assets, risky assets. And the other first order condition is going to be giving me that the expected excess return on holding domestic and the foreign assets are going to be equal. So what do I get in this world? That whenever uncertainty arises, I'm going to be deleveraging not only from, so it means I'm not deleveraging only on the domestic risky assets, but also foreign risky assets. So asset prices abroad will going to be going down. So let me move to the framework in which the full framework, where the banker is not only holding domestic risky asset and the foreign risky asset, but also government bonds. And these government bonds, they are going to be investing in the government bond of the foreign country. And this government bond, so these are government bonds denominated in the foreign currency. So these are Turkish bonds in Turkish lira. So the banker balance sheet, they are going to be investing in home asset, foreign asset, and also the Turkish government bond denominated in dollar value. So, but importantly, we are not assuming that this B star is subject to incentive compensation, so they cannot run away. These are safe assets. Still, you will get a first order condition which tells you that, on expectation, UIP holds, but there's a risk premium associated with holding foreign assets, foreign government bonds. So when uncertainty arises, these are type of productivity shock, think about that. And then this is gonna give rise to a usually depreciation of the foreign currency. So in bad times, the foreign currency is a bad asset for you. So you would like to require, so you would require as a bank risk premium, UIP premium for holding these assets, despite the fact that in standard model, given the UIP condition, home risk-free rate go down, foreign risk-free rate go up, you would expect in standard model, Turkish lira appreciates because of higher return on Turkish lira, but it's not. Because of this deleveraging pressure, now the covariance of the banker's stochastic discount factor with the exchange rate is high and negative. That is going to be creating a depreciation pressure. So I already talked about that, but this is important. So I want to go over it one more time, that the banker stochastic discount factor, because the banker is pricing the asset and also the foreign exchange. So the covariance between banker stochastic discount factor and the exchange rate on holding like Turkish bonds is high and positive with the negative turn and more elastic to the increase in the uncertainty. When the constraint is tight, you really want to get rid of those assets, including these Turkish bonds, even though they are not really increasing the fact that you might be more constrained, but they are still risky assets. So what we find is that in the standard model with CAPM, you have with standard parameter of rho, the UIP premium is very low, but you get very high value in the model with the uncertainty. But again, so I want to emphasize, it's not only the amplification, but you also get the correct magnitude or the way that the exchange rate moves is consistent with the evidence in the model with the banker. So just to show you what we get, we put them into a standard model, VAR. We identified the uncertainty shock. And in the model, as I show in the beginning, we have credit spreads, UIP premium, and exchange rate. When you run a simple VAR with the identified wicks, you see that the model gets the increase in the corporate spread in the US, abroad, and emerging markets, consistent with data. Also, you see that the high volatility is associated with the depreciation of the foreign currency, as in the data, and the UIP premium rising. So I don't have much time because this is also a work in progress, but in the last piece, so what we are doing here, we test the model prediction in a more involved econometric framework where we have data from several emerging markets and advanced countries. And this data, we have corporate bond spreads. We don't only look at corporate bond spreads, but also other risk assets like lending deposit spread, equity prices, UIP deviations, CIP deviations, exchange rate. And we estimate a local projection model where we have this identified shock to the risk weeks. And the risk is, this shock is identified as in Bazubundik. And this is the identified shock that, as you see, at times of high stress, this index is spiking around COVID period and also around the global financial crisis. But this model is generating what you would kind of expect. And you can differentiate between US and the emerging markets. You see that the in times of high volatility is associated with high spreads in emerging markets and also abroad, high loan spreads, lower equity prices, which is what the model is predicting. CIP deviations and also UIP deviations, especially in emerging markets, are showing that they go up quite a bit, and there's less evidence on the AFEs, but EME currencies are depreciating. So if you single out the role of the net worth, there's more amplification coming with our some initial evidence we have. But just to conclude, here today I show you an open economy model with endogenously risk-averse intermediary. And there's international spillovers, as you expect, consistent with the empirics, with financial integration, uncertainty shocks transmit one-to-one, and these uncertainty shocks generate also outflows from emerging markets, increase in risk premium, and also depreciation. So.
Right. And and we now have the discussant, Luisa Campanile.
Okay. So first of all, let me thank the organizers for allowing me to read and discuss this extremely rich and interesting paper. The usual disclaimer applies. So in a nutshell, within the broad field of the global financial cycle, the paper specifically explored the interplay between an uncertainty shock occurring in a large financial center, large advanced economy, the US, and the evolution of asset prices and risk premia in both regions, both emerging markets and advanced economies, as well as capital flows exchange rate dynamics and uncovered interest parity, and they do it with both a model and some empirical tests. First, a two-country dynamic macro model that features banks operating globally and subject to financial constraints, and then a set of empirical tests of the model predictions. In the theoretical part, the paper does an amazing job at breaking down the specific channels of transmission, starting from autarky, going all the way to financially integrated to good open economy. So starting from the first building block, it shows how uncertainty actually affects domestic asset prices and risk premia through financially constrained banks operating via an excess return that intermediaries require from holding the risky assets due to endogenous leverage constraints. It then goes on showing how uncertainty has a similar effect also to foreign prices and risk premia. And here the channel is a sort of an arbitrage mechanism once you allow these global financial intermediaries headquartered in the advanced economy to hold both domestic and foreign risky assets. And the third building block is then opening this model to exchange through differentiated goods. You have that uncertainty also raises the excess return required by these global intermediaries for holding the emerging market currency. And so there is a risk adjustment channel that dominates a standard interest rate channel that makes the dollar appreciate. And then the paper goes on with an empirical analysis that basically has three components. First, the identification of this exogenous uncertainty shock from the VIX. Second, it estimates the different channel of this spillover to emerging markets financial variables through panel VAR, and then it evaluates the intensity of this spillover based on the degree of endogenous leverage constraints that banks have depending on their net worth. My comments are gonna cover 4 dimensions of this work. The paper is a pleasure to read, extremely interesting. So these are just comments that aim at strengthening some messages of the paper and possibly suggesting some food for thought for further research avenues. So first, the model does an impeccable job in explaining how a second moment shock to this domestic productivity riskiness, domestic riskiness impacts on global financial variables. But at the same time, the reader might be left wondering what exactly is this type of exogenous shift that leaves average productivity unchanged, at the same time changes the dispersion of productivity. So the paper starts off mentioning the 2023 March distress in the US banking sector, but that might not be the most suitable example to start with, because that's precisely a shock that originated in the banking sector, not in the real sector or in the riskiness/productivity arena. And it's a shock that originated in domestic banks and didn't spread out through the global financial/banking industry. So you might want to think of some episodes that allow you to visualize this type of shock. And I think it will, like, strengthening this type of storytelling will also help you clarify how this uncertainty shock does not originate from a monetary policy uncertainty mechanism, and possibly set it apart from a first moment shock or a second moment shock. So in the paper, you often refer to bad times. So when I read or when I hear bad time, I want to understand precisely what type of shock you're thinking of. And at the same time, you might have a type of skewness, but tails getting fatter story that you might want to be sure that it's different from what you have in mind. Second, there are two papers that you might want to refer to sharpen your results. First one, it's a 2020 GME paper by Batara and co-authors. Here, I'm just reporting the elements of the paper that I think are closely speaking to your results. So you might want to sharpen your message by comparing the mechanism that drive the similarity in both paper, and the same thing on, and that was on, this is for your empirical results. So more on the interaction between global banks and the global financial cycle. There is the 2015 Brun and Shin in Restad. You cite the one on the GME, but there's another paper that's possibly also very intertwined with the same topics that you're discussing, and it might be useful to compare the results. And my third comment is on net worth. So I realize it's standard in the literature, but basically the empirical part takes the net worth from the entire banking system. So you're talking about global banks, but at the same time, you're using a variable that it's taken from the entire set of banks. So, and this is not a suggestion to use any other data, but you might want to explore heterogeneity in net worth within the banking sector. And for instance, the Federal Reserve's weekly releases data on unconsolidated banks' balance sheets that contains the breakdown between large and small banks. It's very, I mean, it's a raw breakdown, but if you look at that, you start to, and we know that size is just one of the many dimensions of global banks. The literature on complex banks pioneered by Linda has shown, but still you might want to look at size as one dimension that could make you distinguish global banks from smaller banks and see if they behave differently. Fourth, okay, this is a bit more technical on your VAR shock identification. So you're using recursive Cholesky method that might not be the most well suited to address an uncertainty shock on financial variables that have low frequency. So there's a recent paper by some colleagues of mine that actually proposes alternative methodology to overcome this type of technical obstacles. And also I have a small remark on your panel regression. So over your time span, you have that advanced five of those advanced economists entered the euro area. So you're going to have a shift in the variation on all of your variables related to exchange rate. So thank you very much.
Thanks a lot, Luisa. So maybe, Özge, you want to take a few minutes, but not too long, because we also want to see our questions.
Sure. Thank you, Luisa, for the great discussion. So on the shock, we don't take a stance on, so there's an exogenous rise in uncertainty. We don't really take stance on why uncertainty rises. But this means in our framework, when uncertainty increases, expected excess return on investment by banks is more uncertain. So there's a variation there. So there are other ways of thinking, but as you see in our figure, this uncertainty is we see that it spikes in well-known episodes. There are other ways of identifying, as I said. One way also we are thinking of Hassan et al. And some other papers that have been using other methodology for identification of the shock. So we get somewhat similar results when we think about the return or the volatility in somewhat different way. But overall, we don't take stance of why we see the uncertainty. This is a shock that endogenously generating a high risk aversion at the bank level. The other comment that you have on the West literature, yes, there is a literature. Bruno Shin, Helen has worked on that. So the global banks are important in the transmission of shocks. So we are not the first thinking about that. I guess, as I mentioned, this is really in my mind, is the first framework. I want to know if there is many more that generates all these facts in a unified framework. I spent a lot of time explaining the asset price, but this is really at the end showing you this is the framework that can generate CIP deviations, UIP deviations, and also capital outflows from emerging markets and a depreciation of these currencies at times of high uncertainty. This framework is rich, very simple, but rich enough to generate many of the facts that we have seen in international financial markets now. Maybe I should change the focus more on the UIP, CIP, and the dollar front, and also capital outflows, because again, the standard models don't really get any of those. There's capital inflows to emerging markets, and there is appreciation of the currency in our standard models. This is a framework. We are saying this is a way to think why this is happening. There are other explanations that there is safe asset demand. You didn't bring it up, but this is very related to your comment. We see that these are like complementary explanations in terms of how we think about the appreciation of dollar in bad times, because there's also, we are thinking here is the deleveraging pressure on the emerging markets, currency or assets, but there's also the other side that the safe haven flow also generating. So these two channels are pretty complementary. I agree in terms of, I'm gonna talk to Linda definitely on the leverage question that you have to understand, so to see how we can use the heterogeneity with their data to incorporate in the framework. But one thing that we are changing, so I agree with you in terms of the empirical evidence that we see CIP and UIP is less of a, so at times of high uncertainty in the empirical VAR, panel VAR, when you split between emerging and advanced, it is less of a problem, or you see the effect is smaller and less significant in advanced countries. It is there, but it is really the emerging market phenomena that, or it is more obvious there in the evidence, in the data, that at times of high uncertainty, they see the CIP widening up, UIP widening up, there's large capital outflows. So maybe I should find a way to tweak it more to the emerging market versus the US, but some of the evidence is also there for advanced countries, maybe not as strong.
Super. So now there's Anusha wanted to ask a question, and Katerina.
Thanks, Oscar. Very interesting paper. So I have two questions. One is related to the composition of capital flows to emerging markets, which now non-bank financial intermediation exceeds banking flows. So I'm just wondering given that in many of these countries, NBFI flows are greater than banking flows, what does that imply quantitatively for the results that you document? The second question is related to the provenance of the risk shocks, which is there are structural approaches like the VIX conflates the price of risk with the quantity of risk. So are you talking about macro uncertainty or are you talking about time varying risk aversion? Could you decompose the two? And related on an empirical front, the provenance of risk changes over time. So, during the GFC, we see that, credit spreads and advanced economy equity volatility were important, but during the COVID crisis, liquidity risk became very important. And this sort of impinges on financial intermediaries. And so, can you think a little bit more about that?
Let's collect, because we have actually 4 questions. So, Katerina.
So I wanted to ask you, if I understood correctly, what you really care about is shocks that generate this high risk aversion. And I was wondering if instead of looking at these uncertainty shocks, if this is what matters for banks, why don't you look at the slows? In the European Bank Lending Survey, we have measures of bank risk perception. And maybe this is something you could look at to tell a more convincing story that this is something really related to the banking sector, as Luisa was saying, rather than to productivity or other factors in the economy. And my other question, it was more of a curiosity just for me to understand, how would this be different in the model from a network shock?
Good. Monica, and then Linda.
The way, as an outsider to the international literature, the way I sort of think of these facts about currency markets is that seems to be a strong common factor in risk premia in currency markets all across different currencies. And here you're micro-founding this in terms of the risk premia that these global banks demand for holding this type of risk. I thought the other fact that people talk about is that there's then country-specific loadings on this kind of risk factor. And I wonder where that comes from in your setup. Is that, so you have this intriguing setup that the risks across countries are uncorrelated? Is it that the shock in countries like Turkey are just larger, they're more volatility? Like, how do you explain different loadings to this to the shock?
Linda?
So I think this follows on both Anusha and Monica's point, which is there anything here that's specific to emerging markets? So when you have this type of uncertainty shock, is it only emanating from the US banks, or is it common to all global banks? So that's one part of it. And the other part is, even if it's just specific to the US bank, global bank net worth, why wouldn't it emanate to every market around the world where US banks have positions? So what's specific to emerging markets here?
Okay, I think you have your
yes,
part here.
briefly,
Yeah. I'm afraid.
Composition of so here is a simple framework, but the way that we think about it, as in the Gertler-Kiyotaki framework, it is really not really the banks. We call them banks for simplicity, but we think about it as the financial intermediary, overall financial system. So in this simple framework, I show you, yes, some empirical evidence coming from the banking sector. It is just a motivational evidence because we had data and it was easy for me to pull and run the regression with that. But when I think about the framework here, it is really the whole financial system I have in mind. So overall financial system, and they pull out the global like hedge fund. They are having portfolios around the world, and at times of high uncertainty, they pull out from the risky assets around the world. I do have a decomposition. I had to skip it, but the way it works that we decompose the risk premia in the price of risk and the quantity of risk. Both of them are important. At the steady state, when you have the global bank in the autarky, you open up, right? Then there's risk sharing. Risk sharing motive implies that the global bank wants to hold not only the domestic risk asset, but the foreign risk asset, because they share risk and the covariance term shrinks significantly. And there you see it at the steady state, the composition is equal, both of like, it is really the price of risk. You're right, that the price of risk in the transition dynamic that drives most of the result. When the uncertainty hits, you see both the quantity of risk, expected return on capital, and also the volatility of the discount factor, both rise similarly. So that, like in the transmission of uncertainty, both plays an important role. I'm going back to Katerina's question on, this is a great suggestion. I'll definitely look into that. We also have that in the US, and I'm also familiar with the European slews that I would definitely want to take a look. But the first order shock, we have a section in the paper, we show that with first order shock, direct shock to net worth, you don't get the call movement. The way that the interest, so in the Bazubindik, their econometrica paper, high uncertainty, you see that the risk-free rate go down. In the first order shock, when you give shock to net worth, you see, first of all, you don't see spike in the volatility. That is one thing, but putting it aside, you see that the risk-free rate go in the opposite direction. So you cannot get the call movement right. It is really important to think about the uncertainty dispersion in this framework to get the call movements between the asset prices and exchange rate right.
30 seconds.
That is one more thing which I don't have a strong answer, so I have to be honest. I don't have very good answer to your question in terms of how we differentiate, and this also goes back to Linda's question. Here we think about US and the rest of the world, and for now, what we have is really that any risky asset, they will be pulling out, including foreign exchange, including foreign assets denominated in dollar or foreign currency. As long as they are risky, they are pulling out. There's no specific loading on the emerging markets differently than the advanced countries. We are now working on a 3-country, advanced country, emerging market, US. This is like in the computer, we are running it. I don't have the results, but there we will have the differentiation. There is going to be a specific risk on the emerging markets. So that is going to be an additional amplification vis-a-vis the advanced countries. So then we can see the loadings more carefully, and we can also, yeah.
Thank you very much. Thanks a lot. And we now have a next paper with Annie. Yeah.
Okay, so thanks for having me here. I'm Annie Lee from Johns Hopkins University. I'm very happy to present my paper titled Liability, Dollarization and Exchange of Pass-Through to Prices. So let me start with the motivation of this paper. So a sharp appreciation of dollar against domestic currency is not a rare event. So we've seen in the past, we also seen recently. So the dollar hit 20-year high in September 2022, having appreciated by 16% since the beginning of 2022. And such sharp appreciation of dollar can have negative spillover effects to emerging economies. First, a sharp appreciation of dollar against domestic currency can increase the imported input prices, which would pass through to domestic prices, generating upward pressure on the domestic inflation. And this channel would be stronger as emerging economies rely more on the imported intermediate inputs in their production. And second, emerging economies tend to borrow a lot in dollars. So this sharp appreciation of dollar against domestic currency can increase its debt burden, which may bring about the contractionary effect on its macroeconomic variables. So there is a vast literature studying empirically and theoretically this contractionary effects of the dollar debt on the macroeconomic outcomes. But we find that this contractionary effects of the dollar debt on domestic prices, domestic inflation, is underexplored in the literature. So, against the backdrop of this, we are asking two questions in this paper. First, how do firms' pricing decisions change with different levels of foreign currency debt upon depreciation of domestic currency? And second, how significant is this balance sheet channel of dollar debt quantitatively explaining the exchange of pass-through to domestic producer inflation? So before going on to the nitty-gritty details of how we tackle these questions, I just want to show you some motivating figures that show that the traditional import input channel might be insufficient to explain the level of price increase that we see during the depreciation in emerging economies. Okay, so this figure shows the PPI changes on the y-axis. So these PPI changes are for narrowly defined manufacturing sector in Korea from 1996 to 1998, where Korea experienced a large depreciation of Korean won against US dollar. And we plot that against what we call as PPI changes implied by the imported input channel, which we compute by multiplying imported input share and changes in the imported input prices, assuming a complete pass-through of this marginal cost shock. And you can see that most of these sectors actually have higher actual PPI changes than what's predicted by imported input channel. And we just want to emphasize the fact that this is assuming a complete pass-through of marginal cost shock. So we are giving 100% chance to, so maximum chance to the imported input channel, but still we see a lot larger increase in the data than what we think that's predicted by the imported input channel. So there's something else going on, but what's more striking and interesting is the gap between the actual PPI changes minus what's implied from the imported input channel. The larger the unexplained part of the actual PPI change is, those sectors are highly indebted in foreign currency debt. So we see, so this bin scattergram shows a strong positive correlations between the short-term foreign currency debt exposure before the large devaluation and the residual part of PPI changes, i.e. that's the unexplained part of the PPI changes by the imported input channel. So this is where we are going after. So we think that there is neglected balance sheet channel of dollar debt, and that may account for the much pronounced increase in the domestic producer prices that we see in the data during the large devaluation period. Okay, so in terms of literature, so we're bridging two strands of literature, exchange of pass-through to prices and contractionary effects of dollar debt. So there's a vast literature studying the determinants of exchange of pass-through to domestic prices, export prices, input prices, and so on. But our paper is complementing their work by exploring this balance sheet channel of dollar debt in the determination of exchange of pass-through to domestic prices. And we also owe a lot to the studies of contractionary effects of dollar debt, but what we are really interested in this paper is this balance sheet effects of dollar debt on the firm's price setting decisions. And also it is related to the recent literature on the literature about the financial frictions of firms' pricing decisions in a closed economy setting. Okay, so the outline of today's talk, So we explored this large devaluation in Korea in 1997, and we identified this balance sheet channel of dollar debt. And we find first, industry with high short-term foreign currency debt exposure increased their prices more during the crisis. And second, firms with high short-term foreign currency debt exposure have lower sales growth, lower net worth growth, and lower markup growth. So rationalizing this empirical patterns, we built a heterogeneous firm model with two types of financial constraints and important intermediate inputs in the production. And we solve for an industry equilibrium and transition dynamics for upon an unexpected depreciation of domestic currency against dollar, against foreign currency. And we estimate the model and show that it performs well in explaining the sector price dynamics. And we quantify the size of the balance sheet channel in explaining the sector price dynamics. And we find that 15 to 30% of the price changes that we see in the data can be attributed to the balance sheet channel of dollar debt through the counterfactual exercise. Okay, so let me move on to empirical part. So this paper is possible because we have this unique data set from Korea, firm level balance sheet data, which combined with the industry price data. And this data has three strengths in terms of other data sets. So first, it contains information about the currency composition and the maturity of their debt. So we see foreign currencies versus local currency, Korean won, short-term versus long-term. So that's going to be useful because what's relevant is actually the short-term debt. So those debt has remaining maturity less than 1 year. And also this data set contains balance sheet information for not only very large listed firms, but also small, medium-sized firms. And our paper is interested in the role of financial frictions, the balance sheet channel. So I think that's actually a plus. And also some sectors are populated by the small and medium-sized firms. So we're not really leaving out those sectors populated by small, medium-sized firms. And the number that we have, 3,000 firms in the manufacturing sector as of 1996, and consider that during that time, number of firms in all sectors, the number of listed firms in all sectors is 700. So it really contains very small, medium-sized firms in this data set. Third, we have a rich set of firm level variables, and that enables us to control for some of the characteristic that might be related to the determination of the currency composition of liabilities. So we have information about exports and also the currency denomination of liquid assets. So here the most of the liquid assets are cash and cash equivalents. So we have that information about how much foreign currency cash they have on their balance sheet. And we link this data set to the industry level price data from Bank of Korea. So basically there are 155 industries. So for price regressions, we are aggregating to the industry level and we are doing the regression. For other firm level regressions, we do it at the firm level. So of course, it would have been better if we observed the firm level price, but that's what we have. So that's what we do with the price level data that we have. So basically, we explored this large devaluation in Korea in 1997 and different foreign currency debt exposure across industries to identify this balance sheet effect of dollar debt on the domestic output prices. So just briefly, to give you a context why this period is a good for identification. So first, virtually there was no financial hedging in Korea in 1996 because the exchange to trade financial derivatives was established after the Asian financial crisis, which is in 1999. So virtually all the foreign currency debt are unhedged debt. And the devaluation itself was pretty much unexpected. So, I mean, you can see from the quote from the BIS chair in September 1997, and that's like 2 months before the crisis in Korea. And at the time, not just BIS, World Bank, IMF, they all kind of say Korea has strong fundamentals. Korea is not going to face the currency crisis. And boom, 2 months later, we we had a very large devaluation, dropping the fixed exchange regime, and we moved to the floating. So to most of the people, even including those, firms and financial investors, financial intermediaries, all the banks are pretty much, get off guard by this this devaluation. And third, there's a lack of FX borrowing, foreign currency borrowing. So there's no quantity regulation on the foreign currency borrowing. And also, we don't even have to show that this is export related foreign currency borrowing. So that kind of fuels the increase in the foreign currency borrowing and encouraging firms to borrow in short term. Okay. So this is the empirical framework that we have. So dependent variable is the growth rate of PPI for industry I from 1996 to 1998. And we regress that on the short-term foreign currency exposure, which we define as the weighted average of firms' short-term foreign currency debt to total short-term debt ratio for firms in industry I. And the weight here is sales. And long-term foreign currency debt is defined similarly. Here again, short-term includes the maturity at the issuance less than 1 year, and also long-term debt with remaining maturity less than 1 year. So we think it's important to decompose. You're going to see the results, and it's actually important for you to decompose short-term debt versus long-term debt, because what's more relevant for you to for you to think about is how much that you need to repay when the devaluation shock hits. So basically that captures the rollover, how much that you need to roll over, or how much that you need to pay back once the devaluation shock hits. And we, of course, control for imported input channels. So that's imported intermediate input share in the production from input-output table. And other industry pass-through determinants such as degree of product differentiation and degree of price stickiness. So this is a 2-year horizon. So the price stickiness doesn't really play a role. And you will see that in the regression results as well. And we also control for weighted average of other firm level variables. So we control for size, leverage ratio, domestic short-term debt ratio, export to sales ratio, and the foreign currency liquid asset to total current asset ratio. And importantly, so here we also include broad industry fixed effects to kind of mitigate the concerns that, some of the demand components may affect the price changes and so on and forth. So we are trying our best. So we are including this 2-digit industry fixed effect. And given that this is a 4-digit industry, that's kind of the best we can do to kind of mitigate the concerns from the demand shocks. Okay, so this table shows the results, and you see that regardless of including fixed effect or regardless of including the average firm level characteristics, the coefficient estimates are positive and significant, and they're pretty much quantitatively in the similar magnitude in all sorts of specifications. So what this means is one standard deviation in short-term foreign currency debt exposure, which is 10%, will lead to 5 to 6 percentage point increase in the prices. And that number is actually pretty significant because the median producer inflation during the time is 16%. So one standard deviation is 5-6 percentage point higher. That's a very quantitatively sizable number. So I have a few buttons. So one thing that we check is whether we see the pre-trend. So whether the sectors that have high foreign currency debt exposure and low foreign currency debt exposure have different pre-trends before the shock. And that's not something that we observe in the data. And also this increase in the prices is pretty much transitory. And one thing that we have done is maybe, the short-term foreign currency debt exposure is related to the unobservable characteristics, and somehow that's leading to higher inflation in that sector. So we look at the pre-crisis period, we are regressing this 1903 to 95 price changes on the 93 short-term foreign currency debt exposure. We don't see much of a positive correlation. And also we actually see negative correlation when we control everything. So, and also they're all not significant. So not significantly different from zero. So we do a lot of robustness check, but I mean, for the sake of time, we're gonna skip. So to illustrate the model mechanism, so we look at the sales growth, net worth growth, estimated market growth from 1996 to 1998. And the same variables just defined at the firm level, and the same control variables defined at the firm level, but here we include the industry fixed effects at the 4-digit level. So what we see in the data is that, these firms have high short-term foreign currency debt exposure before the crisis, have lower sales growth, lower net worth growth, lower market growth, but that effect is offset when the firms are having larger sizes, which we kind of use as a proxy of the financial constraint. So just take away. So during a large devaluation in Korea in 1997, industry with high short-term foreign currency debt exposure increased their prices more. And from the firm level regressions, we show that the firm with high short-term foreign currency debt exposure have lower sales growth, lower net worth growth, lower market growth, and that effect will be smaller as the firm size is larger. Okay, so just the overview of model, industry equilibrium model with heterogeneous firms. And exogenous variation across industries in our model is the industry-specific firm-level distribution of foreign currency debt ratio and industry-specific imported input share. We use Kimball aggregator to examine variable markups, and firms face two types of financial frictions. So there is a financial constraint that restricts the amount of borrowing, which is linked to the capital they choose. And also there's a working capital constraint where the per fraction of the production costs need to be paid by working capital. And we assume that the economy is stationary equilibrium. We shock the economy with one-time unexpected real exchange depreciation, and we study this transition dynamics of industry price for each of 155 industries. So basically, you can see that the price is markup multiplied by marginal cost and how tight the working capital constraint is. And this balance sheet deterioration has effect through investment and working capital channel. So basically, balance sheet deterioration lowers investment and cash, and lower investment decreases the labor productivity tomorrow, and that will jack up the marginal cost, which will translate into higher prices. But the markups are going to be adjusted because, higher marginal cost, lower production, and that will lower market share and lower markups. And for working capital channel, it just works through the liquid assets and tied to working capital constraint, which again will lead to higher prices. But I think what's more interesting is the strategy complementary. So basically, the firms with zero foreign currency debt react to other firms' change in the prices due to their balance sheet deterioration. So even if you don't face any balance sheet deterioration because you're not holding any foreign currency debt, the fact that others are changing the prices will lead to changes in their markups and hence changes in their prices. So that's something that we see from the policy functions. I'm happy to chat more about this, but given the time, let's skip. So those are quantitative part of the paper. So we just calibrate the parameters. Basically, we just get this distribution of foreign currency debt and the import input share from the data. And we are kind of playing the game, how much we can explain these variations in the industry level prices. So, so I compute this price changes upon depreciation shock for 155 industries. And we have short-term foreign currency debt exposure for each industry and import input share. And we run similar regressions that we run in the data. And we see that the estimates are pretty much on the same order of magnitude. It is, and given that the only variation in the industry is just coming from the short-term foreign currency debt and imported input share, the model can explain more than half of variation in the price changes across industries. So the model generated standard deviation is 0.1 and the data is 0.18. And this is just showing that when you're doing the firm level regressions, they're pretty much aligned with what we see in the data. And lastly, we do a counterfactual exercise where we compare the baseline results with the counterfactual outcomes, where we assume that the imported input price stay constant upon a depreciation shock. So I think this is a fair game because even though there's a depreciation, there's no increase in the imported input prices. And we kind of see how much of the price changes that we see in this counterfactual exercise and compare with the baseline simulations. And we see that, I mean, of course, when you don't have foreign currency, you can't explain much, but in the quartile above 10%, you can see that around 15 to 30% of this price changes are owing to this balance sheet channel of dollar debt. Okay, so let me conclude. Sorry that I was rushed up towards the end, but so basically our paper is about this balance sheet channel of dollar debt. We study empirically and through the lens of a structured model, and we find that this balance sheet effect of dollar debt may play an important role to explain the price level, firm level price dynamics during the crisis, and also maybe this is highlighting the channel that might be important for normative analysis, like optimal monetary policy as well.
Great, so you can here. And it's Kenza who is going to discuss the paper.
Thank you. Yeah, well, thank you for asking me to discuss this paper. So brief summary of the paper. So it's a paper about the pass-through of exchange rate to prices. And it speaks to Isabel's paper because, you know, there is the fact that the import share and the input cost channel does not explain it all. And it's the case here as well. So Annie shows that there is no correlation between that channel and the actual price change. So the question is there a role for financial frictions and more specifically a role for the corporate foreign currency debt? Because with the depreciation, especially when you have short-term foreign currency debts, this translates as a net worth shock. And this is what generates potentially the price adjustment. Now, what they do, they use a large evaluation in Korea in 1997 to identify this channel using the sectoral heterogeneity in the exposure to foreign currency debt, short-term foreign currency debt. And they show that sectors with higher foreign currency short-term debt exposure prior to the crisis experienced a larger price increase. So that's the first piece of evidence. So it's at the sector level, not they don't have the chance to have the same type as firm level data as Isabel. So to still exploit the firm level dimension, so they also provide some kind of indirect evidence at the firm level by looking at the association between the decline in markups and the foreign currency debt exposure. But for that, you need to have to discipline the link between the markup and the prices. And this is what the model is for. The model is a way to also, as I see it, a way to discipline and to interpret the micro level evidence, which is indirect evidence of the price. And they also use it to quantify the role of foreign currency debt relative to the import share. Yeah. Okay, so before I move to the comments, just a brief reminder of the mechanism. Why do prices increase? So the price is, well, the markup times the marginal cost. Here, you can see it also as in the same way, where you consider marginal cost as marginal cost inclusive of the shadow financial marginal cost, so the cost channel, the working capital channel. So in the model, they decompose the price into a markup, which is an optimal markup, the physical marginal cost, and a shadow financial marginal cost. And then when a firm has a negative net worth shock, this total marginal cost increase through two channels, decline in investments because of the long-term borrowing constraint generates a decrease in labor productivity, and you have an increase in the physical marginal cost. But then, because of the short-term borrowing constraint, the firms cannot finance inputs, and that gives rise to the shadow financial marginal cost. But concretely, the constraints, the implication of the constraint is that you cannot use inputs, so you're obliged to contract your production. So it's a de facto rational production. And why does it have an impact on pricing? Because the firms are actually not on their optimal pricing, equation, and the marginal revenue is above the marginal cost. And basically, the price is higher because the consumer is on its demand curve. So low supply means also high price. So it's really a negative supply shocks, both lower productivity and rationing of production. Now, I think it's really important to discuss the relation between the markup and the prices. And here, you have a Kimball demand. With the Kimball demand, the elasticity of substitution is increasing in the price level. So when you have a higher price, you have also higher elasticity of substitution. So you have also a lower markup. And this, helps also to interpret the fact that what defines that the more constrained firms, they have a stronger decline in markup. So if you believe in this mechanism, that means that probably there is an increase in the price. So the markup provides indirect evidence. But again, this is the markup inclusive, the inclusive of the financial, the shadow financial marginal cost. Yeah, so the markup, this markup, yeah. Okay, so my comments. First, discuss a bit the identification of the cost channel. I think it will be interesting to explore that more in the empirical section. And I have some discussion of the markup, both the estimation and the interpretation of the empirical results. So I think the cost channel, which is really like the potentially strong determinant of the price increase, I think it would be interesting to dig more. And to see if the effect also depends on the labor and material share. Because the working capital, it's a working capital channel, so the firms are concerned in their ability to finance labor and materials, and probably the firms that have higher labor and material shares will be more impacted. And then there are some measures by Radat about the sector level liquidity needs that also I think would be a measure of potentially the size of the working capital channel. So you could maybe look at that. So what you find is, so it's this coefficient that there is stronger decline in markers for firms with higher short-term foreign currency debt. So here, I think you don't control for industry level import share. So maybe I missed it, but I tried to look at the controls. I think it would be important or even industry fixed effects in general. So do you control for more industry level characteristics? Because then if the import share is correlated with short-term foreign currency debt, then part of the effect could be driven by the increase in variable costs because of the depreciation. And because prices may be rigid, that could also be driving the results. So here, I would try to control more for this import channel, and more generally, well, in fact, the link between markup and pricing can be driven by other mechanisms, and I think it would be important to discuss, for instance, in Gilchrist and Crosser paper, where they look at the link between inflation and financial constraints during the crisis. Actually, it's the opposite. Yeah, so there is an opposite correlation between the prices and the markup. So yeah, we'll discuss that more. But another last thing about the empirics, I think, so this is from the model, and this shows the price adjustment for firms which have a different level of foreign currency debt. And then in blue, you have the impact on the price for highly leveraged firms, and in red, the low leverage firms. And what is interesting is that there is a strong short-term effect, and then actually the effect is temporary. Why is it temporary? Because, well, you have a negative shock on the net worth, so the effect disappears as soon as net worth bounces back. But this is the model, so I'm sure that in the data, like shocks on net worth, they are more persistent, and probably it's more persistent in the data. So I would like maybe try a local projection and look at the joint dynamic of net worth and the price, or yeah, well. Yeah, so as I said, it could be persistent, so it would be interesting. And then, yeah, so there is another. So as I said, the link between price and markup, it depends a bit on the assumption you make. But there is another challenge: is the markup estimation. It's an issue in general, but here I think it's even more. I think it deserves more discussion. So you use the Deloker and Warszewski approach, which simply consists in looking at the change in the inverse cost share of variable input. And then the question is, to what extent is this measure related to the definition of the markup in the model, in the paper? And the way it's measured by Deloker and Warszewski is that the markup is proportional to typically proportional to the inverse cost share, but here, because of the financial constraint, there is a wedge. Yeah. So in the end, what you measure, the change in the cost inverse cost rate, it's equal to the optimal markup, the one that is supposed to decline when the price increases, but also is increasing in the financial friction. So I think make it maybe clear that the markup is measured in the model is measured in the same way as the data. Finally, last comment. Yeah, so you have all these channels of the price markup, marginal cost with investments, and the cost channel would be interesting maybe to decompose in the model to see what drives, what are the main drivers. So that's I'm done basically. So,
yeah. Thank you very much. So Annie, you take just a couple of minutes because we don't have much time, and there's time for one question. So if somebody has a question, but please start.
Okay, thank you so much for discussing my paper. All the comments are well taken. So basically, this is a net worth shock. So any type of balance sheet deterioration will lead to the same conclusion. So it's not just. So I think what's interesting is exchange rate shock affects the dollar debt, and that's why I emphasized the role of dollar debt in explaining the price dynamics. But any sort of net worth shock will kind of play similarly in our model and also in the data. So we did look at the cost in terms of expenditure on the labor and other costs, and that kind of supports. So there's a lower labor, lower liquid assets, lower labor productivity. So that is kind of supportive of the key predictions in our model as well. So we did include industry fixed effects in our firm level analysis. So this kind of, I think, solves the concern that you have. So Gilchrist's paper, excellent. So that actually financially constrained firm increased their markups because there's a customer-based theory where you kind of, because you have a sticky customer base, so you increase the markups, charge higher price, you increase your liquidity today for the sake of tomorrow's liquidity. So that channel is not really consistent with our empirical finding for our markup, proxy of markups. So that's why we didn't go to that route. Yeah. So local projection, great idea. We haven't done that. I think it's more interesting to see the dynamics of the firm level variables since we have panel data. Yeah. What else?
We can.
Oh, so
yeah. We can take the question also of Anna, maybe.
Okay.
So you can, yeah.
Okay.
So thanks a lot. It's very interesting, this channel that you highlight. I was wondering, you've shown that the devaluation was unexpected and we believe it, but I was wondering whether these firms, like why they have such a big share of debt denominated in foreign currency, if you have an idea, and why they don't hedge for this, even if they didn't expect the devaluation. I was wondering, why they're so exposed.
So it's cheap. First, it was cheaper to borrow in foreign currency, and the domestic financial market in Korea at the time wasn't really developed. And the fact that, if you don't expect depreciation in the short time, it's cheaper, why not borrowing a lot in foreign currency? And also regulation, no regulation on foreign currency, that kind of helped as well. Yeah.
You want to add one thing we wanted to finish?
Oh yeah, so markup, we are aware with the issue. Maybe we can actually directly use the same way of measuring or proxying the markup in the model and the data and see how that goes. But one rationale maybe is that in the firm level analysis, we are trying to control for kind of the proxy of the financial frictions. So in a way, we are kind of controlling for the effect through the financial constraint, and we are interested in how the markups, the rest of the component would play a role. Yeah.
Thank you so much. I think that was a great session.
Thank you.
And now I believe we are moving outside for the poster sessions, and we can have coffee while, learning.
Oh, it's just for the streaming. Everything else here in the room. Första gången i vilket? Så. Ja, nu funkar det. Ja, det funkar det.
So yes, please, Leslie, go ahead.
Thank you. Thank you very much to the organizer for having me and including this paper on the program. My name is Leslie Shen, and I'll be talking about risk sharing and amplification in the global financial network. This is joint work with Tony Zhang, and we both work at the Fed, and the usual Fed disclaimer applies. Okay, so the key question that we're addressing in this paper is central and international economics, which is the extent of international risk sharing, or put from the opposite perspective, the extent of international transmission. And there has been a large strand of literature, some contributed by the many in the room, that banks play an important role in transmitting shocks across borders. And indeed, they intermediate a large share of cross-border capital flows. They intermediate about greater than $30 trillion of cross-border capital flows annually. And from the perspective of total credit for a given domestic economy, on average, that's about 65% for a given economy. And there has been literature such as the global financial cycle literature started by Helen Ray that shows that global banks, they amplify the transmission of, say, US monetary policy, which can result in cove movements in asset prices and capital flows. But at the same time, there are some limitations in existing literature. Okay? So on the empirical side, much of the work is in terms of reduced form. It estimates how the supply of bank lending to different countries respond to specific shocks, taken as exogenous, kind of a demand for different types of funding, as well as the prices. And on the theory side, normally these questions are viewed from the lens of one representative financial intermediary. And at the same time, it also remains an open question how the role of banks have evolved since the global financial crisis in affecting international risk sharing and shock amplification. Okay. So our paper, we want to provide a systematic analysis of the role of the global financial network, which we'll define a little bit, in facilitating international risk sharing and shock amplification. We account for both the supply as well as the demand for these bank loans. Also, we account for quantity as well as prices, and we do the analysis both across country and over time. And we're going to stress that it's important to take into account kind of the heterogeneity across intermediaries for understanding these questions of international risk sharing. So this is the framework that we have in mind to start with. So you have, let's say country A, they have a banking sector, and they can lend to banks in country B that gives rise to interbank flows. They can also lend to firms in the domestic economy as well as in other countries, and that gives rise to bank to firm credit. Okay? And if you kind of pop back up, the bank-to-bank flows make up the global interbank network, and the bank-to-firm flows make up the global credit network. And together, they make up what we call the global financial network in our paper. And as you can see, banking sectors around the world, they form complex cross-border relationships with banking sectors abroad, as well as corporate sectors abroad. So as an overview of what our paper do, first, we provide a structural model that encompasses both the global interbank network as well as the credit network. And we included it, endogenous supply and demand as well as price and quantity. And the framework is built upon the Koujin-Yogo literature of Memmis asset pricing. Familiar with that? And we're going to estimate from the model, cross-border loan supply and demand curves for 19 countries from 2009 to 2019 using bank balance sheet data from the BIS. And then using the estimate model, we are going to conduct counterfactual exercises to quantify international risk sharing, or what we call insurance provision, as well as shock transmission in the global financial network in response to country-specific funding shocks. And what we mean by insurance explicitly is this endogenous increase in funding that the shock countries could receive in relative to the size of the shock they experience. And transmission is kind of the endogenous decline in funding in response to a foreign local funding shock. So a preview of the main results. So we provide kind of the first set of estimates of these cross-border supply elasticities in literature. And from there, we can show that there's significant heterogeneity in banks' willingness and capacity to provide intermediations across countries. And these elasticities, they explain the variation in insurance provision, as well as the extent of shock transmission around the world. Borrower countries with lower supply elasticities, they're going to receive less insurance when they experience country-specific funding shocks. And we show that over time, the supply becomes less elastic since the global financial crisis times. As a result, insurance provision in the global financial network has decreased. Okay, let me start with the framework. So the framework is very much represented by this figure that I described earlier. So there are N countries indexed by N, and there are two sectors, so banking sector and corporate sector. And each sector is comprised of N+1 borrower, with +1 being kind of the outside borrower that we do not model in our 19 countries, if you want to think about the empirical setup. So we, as I was saying, we built on this Koujin-Yogo Memmis asset pricing literature, and we model out the portfolio shares of these capital flows, banking flows across countries. So country N's bank supply to country M, sector L, follows a nested ledger structure. It's made up of a within sector component. So the within sector portfolio shares and the cross sector portfolio shares. And this nested ledger structure can be derived from a classic Merton style portfolio allocation problem. So for the within sector portfolio shares, the portfolio weight on country M in sector L is made up of this delta, which is kind of a desirability parameter, capturing how much foreign banking sector would like to lend to another country in the given sector. Okay. And more explicitly, this delta is an exponential function of price characteristics. So you can think of, GDP of the borrower country, as well as kind of a trade relationship, let's say, between the lender and the borrower. And there is a latent supply term that captures any unobserved characteristics. And we know from the literature that for corporate loans, the price is usually, for cross-border corporate loans, the price is usually in dollars. So we embed this spread between the domestic currency and the dollar to capture that in these, the corporate sector, that the currency denomination is usually in dollars. Okay, and similarly, there is this cross-sector portfolio weight that the numerator is again capture the desirability of a banking sector to lend to that particular sector. And the lambda term here captures the substitution between the two sectors. So as the one sector becomes more desirable, there's going to be more capital flow shares shifted toward that sector. And then we embed two new elements into the model. First, we are going to endogenize total assets in each banking sector. So the total assets in a given country and a period T is made up of this domestic funding component. So you can think of deposits, non-bank funding, any funding sources of a banking sector. And there is going to be funding that's coming from the global interbank network. And this part depends on kind of the banking sectors around the world, as well as the capital allocation decision that's made by these banking sectors. So these enter endogenously into our model that creates the global interbank network. And then we're going to also endogenize loan demand side. So the log quantity of loans demanded by a given sector in given country N is a function of the price, the characteristics, so capturing like a business cycle characteristics, and there's a time fixed effect as well as latent demand. But now, given that, we wanted to add some endogeneity on the demand side, but the focus of the model is really on the supply, so on the banking sector. And to close the model, we impose market clearing conditions. So in the banking sector, as well as the corporate sector, the total value of loans demanded by each sector in a given country must equal to the total value of loans extended. And there is also an exchange rate determination equation where the exchange rate is determined by the interbank rate differentials between the given borrower country and the US dollars. US dollar interbank rate, the US interbank rate. Okay, so then we estimate the model, and the data we use is from the BIS, and this data kind of uniquely is appropriate for our setup because there's kind of a one-to-one mapping from the model to the data. Right? The data is going to tell us now, for example, how much the US banking sector is lending to the German banking sector and the German non-financial sector in each given quarter. And for borrower-lender characteristic, we want to capture characteristics that contain risks, and expected returns. So for that, we include the GDP, GDP per capita, inflation, sovereign default probability, stock price volatility, monetary policy rate, and index capturing the stringency of regulation of the countries. And we also include like bilateral characteristics, including distance and trade exposure. For price, we use the interbank lending rate for the interbank sector and the local currency prime rate and the USD, US dollar cross-border lending rate for the corporate sector lending. And our final sample consists of 19 countries from 2009 to 2019, including 4 emerging market economies. Now, to estimate the model, the nested loaded structure yields 2 linear estimation equations. So there is going to be a within sector supply estimation equation where the log portfolio weight in a given country as a share of the outside country is a function of the price, the characteristics, and the latent supply curve. And there's also going to be a cross-sector supply estimation equation. And we do these estimations using rolling regressions to kind of get a time series of these elasticities. So we're going to do 30-quarter rolling subsamples. And as you can see, there is a common endogeneity concern in these type of equations. So high portfolio share and high prices, they're endogenous to high latent supply, so that would bias the beta upwards. So to address that, we use empirical strategy that's common now in kind of the demand-based asset pricing literature, but that's borrowed from the IO literature, where we use the structural model to construct implied instruments for the prices. So explicitly, we use variables that's plausibly exogenous to the latent supply that are borrower characteristics, population, GDP per capita, distance to the different lender countries, and a home bias variable. So the key intuition here is, if you think of countries that are larger or more geographically distant from large lender countries, they're more likely to demand more loans. As a result, they would face higher interest rate. And I want to stress that the instruments are a nonlinear accumulation of all countries' exogenous characteristics. So it's not only that Mexico is close to US, but also that Germany or Turkey is farther from the US. And so all these bilateral relationships are taken into account when we think about the estimation identification strategy in the background. Okay. And to estimating loan demand curves, we use kind of a standard IV strategy where we instrument the borrowing price with regulation stringency of the own borrower countries. Okay, and the assumption here is that these regulation stringency measures are correlated with contemporaneously in demand, and they really move the supply of loans. Okay. So the first set of results, I'm going to talk about kind of the within sector supply curve, which is going to give us the elasticity measures. And we find that banks supply more loans as prices decline, which goes with our intuition. And that banking sector is more willing to lend to larger countries that are closer to them. And the key estimates here are the coefficients on log prices. And if we translate them into elasticities, we find that a 1 percentage point increase in lending rate leads to about 37% increase in the quantity of cross-border interbank loans and 67% for the corporate loans on average across countries. Okay. And these elasticity estimates are similar in magnitude to kind of long-term debt estimates from the College and Yoga literature. Okay, so these supply elasticities are the key objects of interest. And we can decompose them into two objects of interest. So if we write out the whole equation, there is kind of a willingness to lend component and capacity to lend component. Okay. So to give some intuition, so this is what our estimates tell us about US banks' willingness to lend to foreign firms. On the x-axis, it's the portfolio weight. On the y-axis is this willingness to lend component. So as you can see, the willingness to lend component is increasing in the portfolio weight, and US banks are most willing to lend to German firms, followed by Japanese firm and Canadian firms. And now if we plot both the willingness to lend and willingness and capacity to lend components in the same graph, and this is an example looking at the willingness and capacity to lend to UK firms, we can see that US and Australia firms, they have kind of a similar willingness to lend to UK firms, but the US banking sector has much greater capacity to lend to the UK firms. And we can now aggregate these elasticities to the borrower country level. And what this graph is showing is just that in the banking sector, in the corporate sector, as well as taking into account both domestic as well as cross-border corporate loans, there's tons of heterogeneity in the elasticities of lending. Okay. So let me walk through a counterfactual exercise to think about if a country is hit with a local funding shock, what does that mean for interbank funding and corporate funding for the shock country? Okay. So the exercise here is think of a US local funding shock. So a 1% decline in US domestic funding. You can think of it as like a regulatory shock or a monetary policy surprise shock that makes the US banks less willing to lend. So focusing first on what that result means for the interbank funding to US banks. So the purple bar first, this plots out the overall effect that can be decomposed into a direct shock effect as well as kind of a rebalancing effect. Okay? The direct shock effect is just you directly holding constant the portfolio weights. US banks have less funding to give to the US banks are hit with a funding shock, and US banks also have less funding to give to, let's say, German banking sector, as in turn, German banking sector have less funding available to the US banking sector. So these higher order effects are captured here as well. But now if we allow the portfolio ways to adjust endogenously, we can see that through this interbank rebalancing channel that dampens the shock effect by about 40%. And we can do a similar exercise on the firm funding side. So there is the shock effect. Then there is a global kind of credit rebalancing effect. So if we allow the portfolio weights to adjust endogenously, then foreign banking sectors are rebalancing back toward the US corporate sector. There is also a self-rebalancing component. So that is capturing both a retrenchment component. So US banks are now pulling money from foreign, foreign countries in the global financial network back to the US. There is also capturing an indirect interbank intermediation effect. So because of foreign sectors are intermediating, shifting their funding toward the US banking sector, now US banks have more funding to give to the domestic corporate sector as well. So both of these are captured in this self-rebalancing act. And together, we show that they can dampen the shock effect by 66%. And we can do this exercise for all the countries in our sample. And as you can see, there's tons of heterogeneity in terms of how much insurance a given country is going to receive when they experience a 1% funding shock. The first chart is showing global interbank rebalancing as a share of the shock effect. So that ranges about 11% to 78%. The middle graph is showing the credit rebalancing component. So that ranges around 4% to 27% of the shock effect. And if we take into account both credit and self-rebalancing, that ranges from 47% and to 91%. And then, so what does that mean for, how do we think about these insurance results relating back to the elasticity that I showed you earlier? If we plot these global insurance measures against the cross-border supply elasticity measures for each given sector, you can see that countries with higher supply elasticity, they receive more insurance in response to domestic funding shocks. And that's because their lenders are more willing and have greater capacity to provide loans through rebalancing when these countries experience local funding shocks. Okay, now let me move on to talk about results over time. Okay? So we do our estimation using rolling regressions based on 30-quarter rolling samples. And as you can see, from the beginning of our sample in 2009 to the end of our sample in 2019, there has been a dramatic decline in cross-border elasticities. The cross-border interbank loan supply elasticity declined about 81%, shown in red here, and cross-border corporate supply elasticity declined by about 55%. So what does that mean for kind of insurance? So if we go back to the 1% decline in US domestic funding scenario that I was showing earlier, the darker purple bar is the initial result I showed. The lighter purple bar are based on kind of the last subsample estimates. And as you can see, the overall effect of the same amount of shock is now much greater. And that's because there is, in general, less rebalancing toward the shock country when there is a local funding shock. And that applies to both the interbank sector, the banking sector, as well as the corporate sector. And we can do this exercise again for all the countries, and we plot out the global insurance measure based on the initial sample period estimates against the final sample period estimates. So anything below the 45-degree lines means that these countries are going to receive less insurance when they're hit with a funding shock relative to the first period. And that is what we find based on our estimates run across each of these countries in both the banking sector as well as the corporate sector. Okay, then we explore one potential explanation for why we observe this decline in elasticities, and that is the changes in regulation that has been implemented over the past decade. So we construct these regulatory stringency measures. We construct one that's based on liquidity requirement and that one based on capital requirements. So the one based on liquidity requirement is more like associated with interbank liquidity for the capital floor, more so with corporate funding. And we find a negative association between these changes in regulation against changes in elasticity. So that suggests that regulation potentially is an explanation for why we observe this decline in elasticity, which has resulted in less international risk sharing in the world. And this is consistent with some of the papers, including that by Linda, that argues, given these regulations, there may have been a migration of risk outside the banking sector into the non-bank sector. So this would be consistent with that. So in conclusion, we provide the first estimates of these price elasticities of cross-border loan supply and demand using a structural model of the global financial network. We find there is significant cross-sectional variation in the willingness and capacity to provide intermediation, and countries with lower supply elasticities, they are going to receive less insurance when they experience local funding shocks. And there has been this significant decline in elasticities, which has resulted in less insurance in this global financial network. And overall, our paper shows that it's important to take account this heterogeneity across financial intermediaries when we want to study questions of international risk sharing and shock transmission. I look forward to Linda's discussion.
Oh. Thank you, Leslie. And Linda is the discussant indeed.
So first of all, I'm so thrilled to be here, and what a wonderful conference. So congratulations to all the organizers and everyone here. Usual disclaimer applies. So first, just Leslie did a great job. Let me give my recap of it. When you think about the borrowing country perspective, and what the global financial network contributes to that country, it has two potential competing things that it brings. One is the benefits of risk sharing. And that is that if you have a domestic shock, when that shock hits, you get an increase in foreign inflows that helps smooth that. But the other side is that money also comes from somewhere else. So there's also an amplification effect that there are declines in funding inflows for countries not directly hit by shock. So you have this kind of balance of both of those. And so Leslie and Tony model each country's banking sector's allocation of interbank short-term funding flows and corporate lending, which is also in the data, just lending, not just corporate, but non-bank financial, non-banks, period. And the network structure builds on Koijin and Yogo's work. There's a portfolio problem that endogenizes both the country's banking sector asset and its liabilities. And this is not at the bank level, it's the banking sector level in the applications. And there's equilibrium conditions with market supply equal to demand for loans. And that's used to endogenize the country loan quantity and interest rates. And as Leslie said, there's a price elasticities estimation done using BIS country level data for 19 countries. It gives you the cross-border interbank and non-interbank loan supply to borrowing countries. And she documents lending banking sector heterogeneity. And at the end, talked about these roles for regulatory stringency and time variation. So it's a very nice contribution. this motivation is really important to understand the kind of stabilizing and destabilizing effects of banking. There's a global systemic view here to kind of get at how much sensitivity to shocks and the mechanisms for these effects. And it's useful to have the full financial sector talked about together. And particularly when you're choosing countries that are home to the global systemically important banks, that is what you get out of this BIS data. And it's also nice that there's state-of-the-art techniques that are brought to this estimation. So I'm going to give a 1A, 1B, and two comments for even strengthening this contribution further. My first set of comments are around the model and the conceptual framework for bank elasticities. And the first question I have is a very basic one, and that is, does the portfolio approach actually align with broader evidence on how banks make these choices? So that's just like a fundamental issue. We do know that banks specialize in types of businesses. We do know that in this kind of global banking environment, there are strategic long-term decisions made in terms of placing flows and placing affiliates. And also that these kinds of choices, these first two choices, are bank specific more than they're banking sector specific. So for example, within the United States, for all the internationally active global banks, they will have affiliate locations and portfolio composition biases that are bank specific. So how do we think about that bank specific type of choice that aggregates together for a banking sector? So these are like just questions that I think would be good to rationalize the choice of the approach. Now, in terms of the interbank flows that are a key part of this, that data, I believe, also includes intra-bank flows. So it's not only funding to unrelated banks in foreign markets, but to your related banks, and those will follow different patterns, interbank to unrelated versus intra-bank. So it would just be useful to kind of understand this, because that really gets at the risk sharing and amplification differences, because they behave differently. And the literature already talks about a hierarchy of sensitivity of when a bank is hit with a funding shock or a risk shock, that domestic lending tends to be more protected than international lending. And within international lending, the related bank lending is more protected than cross-border lending. So it would be very useful to kind of think of this, the modeling approach, and just which parts of this is it consistent with or inconsistent with, and how do we think about that? And I guess a related, these are just big picture questions. The related is how we want to think about the elasticities. And, you know, this is always a trade-off when you're doing something big as you're doing versus something using more granular data. So you're going big, which is great. You see this kind of systemic part, but you also might expect, and this is what the financial frictions discussions of the other papers we're getting at, you might expect that with financial frictions, you might have asymmetry to positive and negative shocks, for instance, or the model, I think, is a linear approach. So you would have the same kind of response elasticity to large and small shocks. Maybe that's not correct. You might have some of these flows where and you can't see it in the aggregate, the country aggregates data, but where the inelasticities are actually driven by committed credit lines that happen when large shocks hit. the banks are constrained to put all of their money in one place. So that would be another kind of positive negative shock linearity question. And I already mentioned intrabank. And I know you focus mainly in the discussion on the funding shock, but I think the role of risk sentiment is also really big in driving these flows. So I'd like to see more discussion of that. Another, and Leslie and I talked about this, another big picture question about the methodological approach that's from Koijin and Moto is the issue of spanning. And so the international banking statistics don't span the supply and demand for credit. So there are banks and non-bank financial institutions, and there's credit through both loans and international debt securities. And we had talked about this yesterday, but risk migration from regulated banks and perhaps outside of the 19 countries of study. It's not damning. It's not damning, but I would like to see context for this and discussion of what it means, and there are fixes, I think. This is a kind of financial system picture that I have in some of my work. And basically, you have global banks. They do their intrabank and interbank lending, cross-border. So this is kind of global bank space on top, and then the recipient country. There are hosted banks and domestic banks in the recipient countries. All of these are lending, providing credit to non-bank borrowers, so the corporates. But you also have non-bank financial institutions that are outside of the kind of financial network here. And when you come to this question of time variation, this is a picture from BIS data as well on the evolving composition of external debt flows, where on the top you have flows where the borrowers are advanced economies, and the bottom are flows where the borrowers are emerging market and developing countries. These panels are the banks receiving funding. So you could think of that as kind of the interbank type of piece. And these are the non-banks receiving funding, which in the context of the paper is interpreted as the corporates. The red is cross-border lending, which is the part through banks. And the blue is the part that's now through international debt securities, which is market-based lending. So, while the banks, the red, dominated all of this funding early on, it's increasingly the case that the international debt securities or the non-banks are at least as large in the funding of certain types of markets. So let's take that back to the spanning. So then I think the question for Leslie and Tony is to, in the paper, figure out how and if, because it's still an if, this kind of spanning question ties in to the elasticities approach. And so I think it would be really useful to discuss and maybe even quantify. You said N+1. So to quantify and discuss the effect of a data gap when estimating the demand system. So I'd like to have like intuition on what that could, what that +1 could be. Now you might be able to get at that +1 by using BIS data on international debt securities. And they have totals from the borrowing country perspective by year. It doesn't span all of the source countries, but you would at least be able to see which part of the demand is met by something, the +1 outside of banking. And I think you might be able to work back what that would mean for your elasticities. And also on the kind of the, risk sensitivity side, as you think about those non-banks, we know that there's evidence, Anusha's work, for example, on extensive heterogeneity in risk response across these bond and equity funds and across institutional funds, retail funds. We had one of the poster sessions also talked about this. So overall, I think it's a perfectly targeted paper. You're asking exactly the right questions about this risk sharing and amplification. So these are critical issues. You're carefully executing it. I think it's kind of unfair to ask about all this robustness and asymmetries, non-linearities, but it might be more feasible to address some of the data gaps and quantify if these are important for understanding the elasticities. So thank you.
Right. So Leslie, you have a couple of minutes to, if you want to answer a bit, and then we'll take also a couple of questions just before lunch. So it's a delicate thing.
Great. Well, thank you so much, Linda, for the excellent discussion. Let me address a few of the comments. So going backwards, the comment about the non-banks. So I absolutely agree. It's important to take account non-banks when we think about, the financial system over the past decade. And they are, to the extent if they, are funding to the banking sector or banks are lending to non-banks, that's captured in our model, right? But of course, it would be nice if we can have elasticities of non-bank funding in additional to bank funding. But at the same time, I don't think that, invalidates or biases our bank sector elasticities, because the key variation we're exploiting here is cross-sectional, right? So we are focusing on portfolio shares, and we're thinking about, whether a banking sector is wanting to lend more to Japan versus the US. And so the object here is kind of, again, portfolio shares, not the overall amount. So in general, I think our estimates here for cross-border lending elasticities are not biased given that. But of course, it will be great. I absolutely agree that if we can add the banking sector into the model and tries to estimate these non-bank sector lending elasticity in addition to the banking ones. And there are various hurdles. To begin with, the data, there isn't by source country, by destination country, non-bank lending data. And price would also be a key parameter, key variable here. As you can imagine, like a relative price differential between the banking sector loans versus non-bank sector loans will ultimately drive a lot of the movements. And as some of Linda paper have shown, there's great heterogeneity in how we think about non-banks. There's more hedge funds, pension funds, mutual funds. So what is really the price of these non-bank funding is something that we need to think more about. But we very much appreciate this comment. So the comment about intrabank flows. So right now, intrabank flows and kind of traditional interbank flows, we group them together all in our interbank flow measure. And that is also because of a data limitation. So there isn't systematic data on intrabank breakdowns prior to 2014 for the countries are sample. So what we call interbank elasticities right now is kind of like, an average of intrabank and interbank elasticities. And we looked at the time variation in these intrabank flows, and there hasn't been, it's pretty much flat over the time period. So our results are not really biased, but it will be, of course, be nice if we can, again, tease apart the intrabank flow elasticity versus the interbank flow elasticity. And I think, about our approach, I think the nice thing about our approach is, it perfectly maps to the data by design, and we can use this kind of uniform model to understand the questions of that's our very systemic in nature about international risk sharing and shock amplification. And there is nonlinearities in the model. So we have actually done exercises where we looked at small shocks versus large shocks. And if we have done exercise where we try to simulate the global financial crisis shock, and we can see that the shock becomes large enough or affects more and more countries, all the countries start trying to retrench to their home countries.
Thank you, Leslie. So we have one question, Nicoletta, I think.
It's very interesting. I have just a curiosity. How do you explain Turkey having one of the highest cross elasticities? I don't understand that. The other one is how this analysis. So bank lending, this kind of can be casted in the wider literature of capital flows, and banks are not the only ones that move flows to corporates and others, and their official flows and other flows. But you mentioned changes in regulation as a possible explanation to the fact that, there's been a decline in, the insurance activity of the global financial network. But, there was a speech by Mark Carney. There's been a lot of debates about capital flows at risk, showing that, push factors and pull factors have lost, some of the grip on explaining, what determines the flow of finance across countries. And there's a much bigger role for the changes in the pipes, by which he means changes in the structure of the global financial system. And that means that now a lot of the decisions on whether to lend or not lend cross-border are driven by algorithms and other, mechanisms that have really changed since the global financial crisis, a lot of the way that, these things happen. And I wonder if that could be an explanation, and if you have looked or considered that at all.
Oh,
Go ahead. Very last one, because
so congratulations, it's a great paper. So I was just wondering whether you could say also something about not only actual shocks, but news shocks, whether you could have some elasticity of, maybe some announcement, and your elasticity could react also to, news and not just actual shocks. And then the second is, maybe related to Linda's comment, and it's about, the role of, the cost of acquiring information for a bank that has to lend across countries. Maybe the role of within branches could maybe reduce this cost in acquiring information across, at the single branch. I don't know if it was clear. Thanks.
Great, thank you. So for the Turkey question, it's partly driven by how we are presenting our results. So we are putting, for each of these countries, they're hit with a 1% local funding shock. So for Turkey, a 1% local funding shock is of a much greater magnitude relative to the Turkish economy. But at the same time, it's a small in magnitude relative to all the rest of the world in terms of capital flows and bank funding capacities. So when Turkey is hit with a funding shock, a lot of countries have capacity to provide insurance to Turkey in terms of the absolute loan amounts, because we are weighting everyone by kind of the same denominator hit with the same percentage shock. That's why the elasticity measures based on that kind of weighting structure, we observe a higher elasticity for Turkey. For the algorithm and changing structure, I think that's a good point. We are not going into detail about all the possible explanations, but I think the change in structure is definitely potentially an explanation for the change in elasticity that we observe over time. And I think we started this exercise thinking about changes in elasticity due to these various changes in regulation or structure that has happened over the past decade. So I think, yeah, that's definitely a potential explanation. And about, so again, you can do various counterfactual exercises in our model if you think the news shock is hitting a particular exogenous variable in our model, you can conduct the counterfactual exercise to see the results. And for the within branch differentiation, and I agree that if we are able to observe kind of the within intrabank flows versus interbank flows for all the countries across time, then we are able to tease out and see if there are an actual differentiation elasticities between the two types of flows.
Thank you very much. Well, I would like to give our thanks to all of the papers, presenters, discussants, and also to the poster presenters who did a great job. So thanks for this morning.
Welcome back to the fourth session of the Women in Macro and Finance Conference. And last but not least, we are going to talk about credit markets and financial intermediation. And I'm now going to leave the floor to Victoria. Thank you.
I want to thank once again the organizers for including the paper in the program, but also for organizing such a fantastic 2 days. It's been a pleasure both in this room and outside, so thank you. So I'll be presenting joint work with Alberto Martin, who is a colleague of mine, and Sergio Mayordomo, who is at Bank of Spain. And here we're interested in thinking about who benefits from credit guarantees if we think of banks versus firms, okay? So the motivation for this paper started with COVID. I think now this paper applies more generally to thinking about the allocation of credit guarantees. But let me just give you a little bit of the motivation and the data that we will use as well. So in March 17th, 2020, the Spanish government implemented a COVID ICO program. It was a large loan guarantees program to deal with the liquidity needs of firms during COVID. So because of this and because of COVID, between March and July 2020, credit doubled relative to the previous year, and 40% of this credit was guaranteed by the Spanish government. Just to give you an idea of how these guarantees work, so they would, depending on your conditions, like if you were self-employed or SME, you would get the guarantee would cover from 60 to 80% of the financing losses to the banks. They had maturity up to 5 years, and the eligibility was very flexible. Basically, it could be, these guarantees could be assigned to any any firm getting credit after March 2020, unless these firms already were in bankruptcy proceedings or arrears and so on. And the most important thing, and the thing that we are interested in, is that these guarantees were allocated through banks. So basically, the government gave banks, depending on their market size, a fraction of guarantees, and then banks could do whatever they want subject to these conditions. What is the motivation for credit guarantees? We could think of COVID, we could think in general. We tend to think that it's some way of allowing firms to get better access to finance, okay? And in particular, during COVID, you would think clearly firms had high liquidity needs, okay? So motivated by this event, what we're interested in understanding is when banks are in charge of allocating public credit guarantees, which firms are more likely to receive these guarantees? What will determine the conditions of access of these guarantees in terms of interest rates? And then this leads us to this question, which is, well, a guarantee is a transfer in expectation from the government. How is this surplus going to be split between firms and banks? Okay, and then once we have an allocation that banks would do, we could think about how inefficient or efficient that allocation is. So we're going to propose a stylized model to think about these questions. The model will give us new predictions that we will test with the ICO program using Spanish data. So the model in one slide, the model is very, very simple. It's a 2-period model, and there's one consumption good. There's going to be a mass of entrepreneurs, okay? And these entrepreneurs at t equals 0 have 2 things. They have some legacy debts, okay? Some money they owe to their creditor bank, and some investment project, okay? This investment project, it's basically operating the firm. It requires K units of investment to continue operating. Otherwise, it has to be liquidated, and you get lambda. So what happens when you do invest K and continue the project? Well, the project has some return A in the case of success. So if the firm continues operating, and then what's important in this model is that the probability of success of the firm will depend on how much effort these entrepreneurs put, okay? This effort has some cost. So, you know, if you work hard, you're more likely to succeed and get your A, okay? Each entrepreneur knows their A, everyone knows their A. Here, there's no issue of asymmetric information. The only friction in this model is that this effort is not contractable. So when you receive your loan contract, the interest rate cannot be conditional on your effort, okay? This is the only friction in the model. And then by simplicity here, we're assuming banks have no funds. If they had funds, then the interesting cases when K is greater than those funds. Funds need to borrow from entrepreneurs need to borrow from banks here to continue operating, okay?
So we're going to have a continuum also of risk-neutral banks. They're going to provide credit at t equals 0, and their outside option is an interest rate of 1. So if a project is continued, banks basically are going to grant new debt with some new face value, okay, some repayments. And if the bank chooses to liquidate, banks will obtain the liquidation value, which for the presentation, let's suppose it's lower than the pre-existing debt, okay? So the model is very simple. Firms arrive to some period, they have to repay their debt. If they want to continue operating, they also need to raise K, and then they put effort and they get A tomorrow and repay their debts, okay? So let's think of the first best in this world. What you would want to do? You know, what is the value of these entrepreneurs? With some probability of success, they get A tomorrow, the output. This is the cost of effort. This is the cost of investment. Any firm that generates a surplus above the value of liquidation should be financed and should continue operating. One thing that we should always make sure here is that, and we see here what determines effort. Well, in the first best, the marginal benefit of effort, which is getting your surplus tomorrow, should equal the marginal cost of effort. That's it. First best allocations are completely independent of pre-existing debts, for example. Now, in the equilibrium allocations that I'll describe now, they will be distorted from first best. And the reason is because we have this non-contractable effort, which is combined with legacy debt obligations and these borrowing needs, okay? So all of the interesting things will come from this. Okay, so I'm gonna try not to rush too much, but okay, so what is the equilibrium look here? And I'm not talking about guarantees yet. I wanna be clear about the equilibrium so that when we understand what happens when we bring in the guarantees. But what is a credit contract here? So firms here to continue operating, they need to raise B0 plus K. They need to raise enough money to pay their pre-existing debts and continue operating. So a credit contract without loss, we can focus at each banks. Remember here, banks are competitive. They will offer an entrepreneur with productivity A, just an interest rate for a loan of that amount, okay? So what is the bank's expected revenue? Well, this is the probability of success of the project, okay? Then if the project succeeds, they get the loan times the interest rate. This is the repayment of the loan, where banks understand, of course, that the higher the repayment they demand, the lower the effort, and therefore the less likely they are to get repaid, okay? So what does competition mean here? In this world, a competitive market requires that the expected return to the bank is equal to the outside option, that it's 1, okay? So anyone in this model could raise funds if this is satisfied. If there's an RA such that PI times RA is equal to 1, okay? For simplicity, also, let's say that entrepreneurs owe this debt to just one bank that I'll call their creditor bank. Okay, so then, you know, given that this is the expected payoff to the bank, we need to think about what type of contracts bank will offer entrepreneurs here. And for this, I'll define this concept of debt capacity of an entrepreneur. And a debt capacity, I want you to think if in the banks, from the bank's perspective, they say, well, what is the maximum repayment I can get from these firms subject to incentive compatibility, okay? So, you know, I'm gonna try to say, what's the maximum I can take from them such that, you know, PA times B is maximized. And I internalize, of course, that if repayments are too high, the likelihood of repayment will be low, okay? This gives me some solution, which is what we call BA bar, okay? What is RA bar? Is the interest rate associated with that maximum repayment. This is just a notion of what is the maximum interest rate in some sense you could charge an entrepreneur. And then once you have this notion, then it's kind of easy to determine contracts in this setting. Those entrepreneurs whose interest rate, the maximum interest rate you can extract is greater than 1, or basically the maximum repayment you can extract is enough to repay this B0 plus K. These are solvent entrepreneurs. These are entrepreneurs that anyone is happy to give them a loan. They have enough funds to repay. Okay, so they just borrow from competitive banks, could be their creditor bank, other banks, and an interest rate where the expected return is equal to 1. And then let me focus here on the last case. If your excess return, if the maximum return they can extract from you, it's not even enough to cover the value of liquidation, then these firms should be liquidated. You know, I shouldn't give them anything. The interesting case that we want to emphasize a lot is that there are a lot of firms for which the maximum you can extract is less than 1. So you cannot charge them an interest rate so that you get 1, but you could charge them something that is better to liquidating them. So these are firms that what the bank is going to do is they're going to subsidize, they're going to lend to these firms, keep them alive. In some sense, they're giving them a lower interest rate than the market would do. And what I want to emphasize is that these captive firms, the only person, the only creditor here willing to lend to these firms is their own creditor bank. Okay, this is a bank you owe a lot of money to, and they're willing to give you an interest rate subsidy to keep you alive. Okay, so we have this type of firms. And then if we want to plot, let's say, productivity here of the entrepreneur, and this is the surplus that they produce, we have, there's one threshold below which firms are liquidated. Okay, in red here, we have the first best. So in the first best, you would want to keep all of these firms alive, producing this amount of surplus. And then what we see is that in the competitive equilibrium, because of the frictions I highlighted, some firms are liquidated. And then also on the intensive margin, they produce less because they put less effort. Okay. So what we want to understand is what happens in this setting when you introduce guarantees, basically. What do guarantees do? So the way we think of guarantees, it's the some amount X of guarantees cover loan capital in case of entrepreneurial failure. So in the event of entrepreneurial failure, the bank gets X from the government. Okay. Like in practice, we can assume that you cannot use this to roll over debt, these guarantees. So let's say the maximum is K. That's not particularly important. And another thing I want to emphasize, there's a finite amount, okay, of guarantees that are given to banks, and it's X bar. So banks have this X amount of guarantees that they need to choose how to allocate. And they can do two things, right? They can offer it to entrepreneurs in the competitive market where they anyone's client, so they could offer them to their own captive entrepreneurs. Okay. So now a credit contract is not just an interest rate, it's an interest rate and an amount of guarantee. Okay. So then this changes the expected payoff to the bank. So now with this probability, the project succeeds, then you get full repayment. But if the project fails, the bank gets XA, okay? What is the cost of granting a loan? Well, first you have to give the entrepreneur K plus B0, but then also there's something that we're gonna define as the shadow price of this guarantee, which is raw. You have finite guarantees here, okay? So it's the limited amount of guarantees. So what you're interested in is you need to think, do I wanna give it to entrepreneur A or B? Okay, rho here will capture in some sense the value of giving it to the marginal entrepreneur, who is the last person to get this guarantee. Okay, and I'll come back to this rho, but the idea is, you know, you have banks that could be competing, but you have capacity constraints on the guarantees. Okay, so here, what this means is that now the payoff to the bank, when I incorporate this, it's basically given by this. Okay, and so basically per unit of guarantee, I gained the if I give the guarantee to entrepreneur A, I get this, and rho is basically what I lose from not giving it to someone else. Okay. Okay, so just from looking at this, it seems like if you're so rho, it will be determined in equilibrium. So you could think that the bank takes rho as given for now, and I'll tell you later how this rho is determined in equilibrium. But in equilibrium, any entrepreneur whose probability of default is greater than rho, who is sufficiently riskier, will get a guarantee. Okay. Yeah, I think hopefully that's clear that there will be a benefit if this is the case. Okay. So then now we want to define again this new debt capacity, because now banks are saying, well, if I give you a guarantee, then what is the maximum I can extract from you? Okay. The only thing that is changing from the problem before is that now the bank understands that if there, let's think that I give you a full guarantee. If there's a default, the bank gets K. What I want to emphasize is that what this is doing to the bank, the marginal value for the bank of the entrepreneur putting effort and succeeding falls. Now I actually don't care as much about you defaulting. Okay, so what that means is that the maximum I can extract from you when I give you a guarantee, it's even more than before. Okay, this result goes beyond guarantees. Anything the bank is doing here to ensure that the entrepreneur succeeds, the bank cares a bit less about this with the guarantee. Okay. So if I give you a guarantee, the maximum I can extract from you is more, because I care less about your probability of success. Okay, so this will be very important to understanding how guarantees impact allocations. So we still have the notion of solvent entrepreneurs is the same as before. Now the threshold changes in the sense that some entrepreneurs that before were captive to their bank now can get the guarantee and go and compete and get credit from competitive markets. And then who gets a guarantee here? So this shows the interest rate and the guarantee. The guarantee will be full for those entrepreneurs that are sufficiently risky. And what I want to emphasize is that relative to those that don't receive guarantees, if you're a solvent entrepreneur with receiving a loan with a guarantee, you do get sort of a lower interest rate. So this is lower than 1, okay? But it's not a full pass-through in the sense that I still have this raw here, okay? Now, a full pass-through would be, sorry, let me be more clear. A full pass-through would be reducing your interest rate by 1 minus PA. Okay, and I'll be just reducing it by 1 minus PA minus RAW. So if RAW is too high, you're barely reducing your repayments, okay? How about captive entrepreneurs? Captive entrepreneurs are doing really bad if they're giving a guarantee. So it's the same, no? If captive entrepreneurs are sufficiently risky, they will get a guarantee. But what that means is that banks will also increase their interest rate. Okay, what relative to what they were doing without the guarantee? Okay, before the bank was nice enough to sort of give you a low interest rate to keep you alive. Well, if they give you a guarantee, then they're actually going to increase your interest rate a bit relative to that. Okay, so for these entrepreneurs, guarantees are going to reduce efficiency in the sense that an entrepreneur now has higher repayments, lower effort. And then those entrepreneurs that are below the threshold, their projects are liquidated. Okay, I'm not talking too much about the threshold. Guarantees do help in terms of, you know, you could be captive and become solvent, and you could be liquidated without guarantees, and now you're kept alive. It could be that you're a negative NPV. So going back to the zombie first discussion, it could be that some firms have a negative present value. You just give them a guarantee to extract the transfer from the government. So if we have to think about the pecking order of the bank, I mean, who does the bank want to give these guarantees to? So here we put the productivity of the entrepreneurs. And here what I'm plotting is what is the profit to the bank of giving credit in the world with guarantees versus the world without guarantees. Okay, so when we see this is greater than 0, it means that banks are making profits just by the allocating guarantees. Who are they getting most profits from? This entrepreneur was the marginal entrepreneur before, the one that without guarantees, they're indifferent between liquidating or not. Now from these entrepreneurs, they make a lot of profits. And why? Because this entrepreneur has 2 things that banks really like. They're very risky, but also they're the entrepreneurs that they can extract the full guarantee. Okay, so they see no pass-through. If anything, they see an increase in their repayment. As the interest rate, as the productivity falls, it is true that these entrepreneurs are even more riskier, but the banks cannot extract everything. I need to give them something to keep them alive. Otherwise I would be liquidating them. So I need to share a little bit of the surplus to keep them alive. How about here? Here I can also extract everything. These were the ones that were captive before, they're still captive, but they're less risky. Okay, so I think that what we want to emphasize from this paper is that maybe the intuition before I wrote this paper was that clearly banks will give guarantees to risky entrepreneurs. And this is saying, well, not so much. I don't care so much how risky you are to the extent that I cannot extract that. So it's this combination of having market power, which in this case, it's endogenous. The market power comes from how much debt you owe to me, combined with how risky you are, okay? And then, sorry, for the solvent entrepreneurs, you just make raw, and then these don't receive guarantees. So then what determines raw? Okay, so here raw affects the demand. So if raw is very high, there's a very low demand for these guarantees individually. The supply of guarantees is fixed, okay? And then this is the demand of guarantees. If the price of guarantees is too high, then no one demands guarantees, or no one is allocating it. Otherwise, you want to give it to the captives and then some solvents, and then some raw clears the market, okay? This is basically, if you think of this literature, as I was saying on, you know, even for solvent entrepreneurs, there's a positive raw. And what that means, if you're competing, but you have scarce resources, what ends up happening is that the marginal price of these guarantees, it's above the marginal cost, okay? There's no benefit from giving a little more to the entrepreneur, because if you attract someone else to give them a guarantee, you don't have more guarantees to give. Okay, so this means that if you give also a limited number of guarantees to banks, that already gives banks market power over these guarantees. So they'll extract some surplus. Okay, so what do we learn? All entrepreneurs that are sufficiently risky receive a full guarantee, but conditions differ. If you are captive to your bank, then the full surplus goes to banks. There's no pass-through of guarantees to entrepreneurs. It's actually worse. There's like a negative pass-through. So you increase entrepreneurs' debt burden and lower efficiency. And for solvent entrepreneurs that you would think competition would help, I mean, it does help, but to the extent that the X is sufficiently small, you can extract also from them as well. Of course, if you flood the market with guarantees, this row becomes zero, okay? So if there's more guarantees than loans outstanding, then there's no row. And then I just want to also emphasize what I said before, that banks could be also funding negative NPV projects at the margin to extract the guarantee. Okay, so we show that allocations differ from also those of a constrained planner that maximizes total surplus. So what we try to think is not so easy to think of what's the appropriate planner problem here. We just wanted to know how distortive it was what banks are choosing to do. And the way we did this, well, I mean, I wasn't going to explain the whole planner problem, but we basically say the planner is going to allocate guarantees to maximize total surplus, but subject to banks' participation constraints. And those bank participation constraints, what mean is like the bank always has the option to lend without guarantees. Okay, if you choose to lend, so the allocation is not basically taking from banks to entrepreneurs. Okay, it's just doing the best it can with the guarantees. And we show that the allocation is inefficient. And it's intuitive. Now, banks are going to prioritize two things. First, the size of the transfer they get from the government. That's proportional to 1 minus PA, the probability of default, but also how much they can extract from it. So captive entrepreneurs or those that they exert, in some sense, of market power. But the planner prioritizes something completely different. Planner is thinking, okay, first, I'm going to give a full pass-through. If I give an entrepreneur a guarantee, I'm going to reduce their interest rate proportionally, full pass-through of the guarantee. And then who do I give it to? Well, if I'm giving guarantees to reduce effort, then I also care about the marginal social benefit of this project. So it's really giving it to those entrepreneurs that have a higher marginal surplus, social surplus. Okay, so the allocations differ a lot, and I don't think I have the graph, but basically banks give it to slightly safer entrepreneurs than banks. Okay, so then we're gonna go to the data. We have data from the Bank of Spain Central Credit Registry combined with central and balance sheet data of the office survey. We have a lot of information on non-financial corporations. We focus on credit given between March 2020 and February 2021. This is the majority of the guaranteed loan was given in this period. We have lots of bank firm relationships. And one thing I want to emphasize, so what are the predictions of this model? Is that if you are a captive entrepreneur, you are more likely to receive a guarantee. And then also conditional on two firms that are relatively equal in terms of risk and other observables, let's say. If they both receive a guaranteed loan, the non-captive one will observe a reduction in the interest rate, but the captive ones will not. Okay, so those are the two new, I guess, predictions of this setting. And for that, it's important to define captive, and this is tricky in the data because it's a statement about market power. So what we said is we're going to define, in the paper we have many other definitions. And the results are very similar. But we said, who is captive? It's a first, it must be that we had a relationship before these guarantees were introduced. And then it has to be that the firm is it's sufficiently risky, meaning it has a probability of default above 1%, which means that your loans are not accepted at the Euro system as collateral. Okay, so it's relatively risky firms that before the COVID, risky, that had an existing relationship. Okay, so the first thing that I'm going to show you, if we look at as a fraction of total credit, which Yeah, so which fraction of total credit was guaranteed? And we see here that if you were a captive firm, you're more likely to have ICO credit, guaranteed credit. And I want to emphasize that here we have fixed effects at the industry, location, size, and risk. So we have buckets of risk. Okay, that's the best we can do. And then most interestingly, and affected means sectors that were affected by COVID more. So it's even stronger there. But I want to show more. It's the one on interest rate. So then if we look now at the pass-through, and I'm interested in understanding how does receiving a guaranteed loan affect your interest rate? On average, it lowers your interest rate, especially if you were in an affected sector. But then if then you look at, well, what about receiving an ICO loan for captive firms? We see that this result is sort of offset. And if we compare sort of A plus B, which is the effective interest rate of a captive firm that receives a guaranteed loan, we see that the coefficient is not significant. So it seems like there's no pass-through to these firms that receive guaranteed loan. Okay, so that's it. We develop a model to study how banks allocate guarantees or split surplus with firms. And we want to emphasize that banks allocate guarantees to riskier but captive borrowers. So not all borrowers benefit the same. Some are actually hurt, and this allocation is inefficient. And these predictions are consistent, at least with the allocation of credit during COVID in Spain. Thank you. Oh, me too.
All right. So I will be the discussant of the paper, and I'm from Erasmus University, and I'm affiliated with CEPR. First of all, I would like to thank the organizers for inviting me to discuss the paper and for organizing this great conference. So far, it has been fantastic. And I want to say that I really like the paper. I like the first version, and I like the second version even more. And just to give you a bit of a background, the paper is based on the large-scale government credit guaranteeing programs implemented by many European countries during COVID. And the target of the program is that they are trying to help the small and medium enterprises and also the larger firms. Those are severely affected by COVID. And the objective of the program is to ensure liquidity and continued activities and to safeguard the jobs. And the implementation is through banks and other financial intermediations, which lead to the question asked by Victoria and co-author. So this paper studies the role of banks in allocating the credit guarantee. And the question asked in the paper include, for example, the incentives of the banks and how are the surplus divided between banks and firms. And finally, is the allocation socially efficient? So basically, this welfare implication is what makes this paper very, very important for understanding the consequences of the guaranteeing program. Right? An overview of the results of the paper, especially the key insights from the model, is that a social planner tilted towards safer entrepreneurs and fully passes the surplus to the firms. On contrary, banks allocate guaranteeing to riskier borrowers. This is because they maximize the transfers from the government. And then the other results showed by the paper is that because the banks are in a strong bargaining position against the captive entrepreneurs, they also gain more by allocating guarantees to those entrepreneurs, and they do not fully pass the interest rate discounts. Okay, and the main finding of the paper supports the model's prediction. For example, the share of the ICO loans are higher for firms with a higher default probability, and also in terms of the interest rate discount. Indeed, for the non-captive borrowers, you do not observe a full pass-through of the interest rate discounts. All right. So what I like about the paper is that this is a particularly relevant question, and also this novel angle to understand the role of the banks to evaluate the state aid measures during COVID, generate very interesting results. And also the paper has a number of very important takeaways. And my comments are going to be centered around mapping the model feature to the policy so that we can understand what is going on and what we can learn from the program. And there are some minor questions about testing the model's prediction. All right, so the key friction, as Victoria mentioned in the presentation, is the data overhang problem. And there are two layers of the data overhang problem. One is even without the guarantee, because of the debt that is going to share some of the profit from the firm, it reduces entrepreneur effort. And second of all, when the guarantee is in place and it's allocated by the bank, it's going to reduce the entrepreneur effort because the bank is in a higher bargaining position. In contrast, the social planner will take into account the entrepreneur effort, so they are resorting in a more optimal allocation if the allocation is done by the social planner. And this is indeed a very important question during COVID. For example, if I'm making some quotes from the FSB report, you can see that they are indeed concerned about excessive rise in firms' indebtedness after the guaranteeing programs implemented by a lot of countries. But as the economy is in the recovery stage, people started to worry about that overhang. And another point that I wanted to make is that this is already in 2022, 2 years after COVID and after the guaranteeing programs are in place. And they only started to worry about the data overhang problem after firms have gone through the crisis and started to recover. And this led me to ask this question: if the guarantees were allocated by the government in the first place instead of the bank, would it be different? Would it be closer to the constrained optimal allocation by the planner as studied in the paper? Probably yes, to some extent, because we know that wealth transfer between the government and the bank is what makes this problem really important in the first place. And if the government makes the allocation, the allocation is going to be closer to the constrained optimal. However, that overhang is unlikely to be incorporated, at least during crisis. And to give you some evidence, for example, if you look at ICO's website and to look at what their objectives are when they were implementing the program, their objective is to maintain employment, to pay salaries, and to safeguard jobs. And this relates to the discussion that we had yesterday about what is the primary objective. Is it really for productivity or for jobs? Okay, and there are a lot of frictions if you look at what is the difference between the planner and the bank, but it will be important to classify what the government could achieve. And then, for example, the government will emphasize more on employment, which might result in this looks like a zombie lending type of behavior. And also the government may not look at the recovery or the long run objectives if they were designing the program. And also they are more focusing on liquidity issue for the reason which cause liquidation rather than productivity, lack of productivity. And also, arguably, they might care about the stability of the banking system. And also, if you think about the allocation without the guaranteeing, the social planner is more like equity-like fund, but when we have banks, it's about debt. So wealth transfer is there in the first place. Okay, and what is really between the government and the bank's objective is this wealth transfer due to legacy debt. I think this is very important and needs more emphasis, and the bargaining power vis-a-vis the captive bank. So I think this clarification would be rather important. All right, let me also make two quick comments. One is that the loan discount is a sharp test against your model. And here, in case anyone asks, what if the government make allocation, would be exactly like what you observe. To give you two supporting arguments, this is unlikely to be the case because of the suggestions made by the ICO and made by the European Commission is against what you have observed. So it's really the bank, not the government. But the bank needs to pay some cost to the ICO, which is varying between 20 to 100 basis points. And if this is correlating with the captive entrepreneurs and riskiness, would it be enough to explain the interest rate pass-through? This is something that you could explore. And also captive borrowers are unique to test the wealth transfer. And I think here you can make use of the heterogeneity in the existing debt in terms of maturity and size to have more identification. All right, let me conclude. By saying that, I really like the implications of the paper, also because if you slightly expand the question to understand who to allocate, to shift from who to allocate to how to design the guaranteeing program to mitigate that overhang, there are something else that could also be useful to think of. For example, maturity structure, short-term versus long-term. You can observe the differences across the country, across the practice, which is related to extent that overhang matters in the first place. And also size, if the guarantee is more scarce, it will lead to more misallocation, and also contractual feature, for example, call provision, which is shown to mitigate that overhang, and collateral requirement, which also add to the line of thinking here. All right, my time is up, and I really like the paper, and I hope this is useful. Thank you.
Thank you, Dawn. So
can I respond?
of
Or?
course,
Yeah,
if
that
we
was
can take to this one.
Yeah, thank you. That was great. I really like the comparison between the government and the planner, because there are a few things that you mentioned that it's true. I think this paper made us realize, okay, then why are you allocating guarantees through banks? Why is the government doing this? Maybe what are the limitations of the government? What is the objective of the government? I do think that with the exception of one of your bullets, which is maybe the government wanted to help banks, which my understanding is that was not the goal. Banks were well capitalized at this point. The government would always want to do a full pass-through, so reduce repayments. This helps with exposed debt overhang, liquidity provision at the time of crisis. So this observing that captive entrepreneurs don't get the pass-through is, I would say the government wouldn't like that, and it wouldn't be aligned with any sort of problem of the government. But yeah, this is very nice. And I think, yeah, we maybe have a follow-up paper, maybe abstracting a bit from guarantees, thinking more about what is the optimal way of providing liquidity given these frictions.
So great. Thank you very much. So questions, we can take a couple of questions.
So very interesting paper. So does the guarantee apply to existing loans too, or it's just for new loans?
Just for new loans.
And are you sure that banks in reality, they just grant new loans, cover pre-existing loans?
So the evidence for
because this
Italy,
is what happens recently in Italy.
Yeah, that's what happened in
observed.
Italy. And I'm pretty sure, I mean, this is why also at some point we even had this written as renegotiation, and now we say, no, one thing you could do is extend the new loan with a very low interest rate. That's exactly the same as rolling over the previous loan and assigning a guarantee to that loan. So there are ways where you could do this that officially it looks like you're not doing it. I mean, we don't do this, we don't check the data here, but yeah, I mean, money is fungible. So it seems like if you had, there are so many ways of assigning it to new loans, even though you're using it for pre-existing. But officially you couldn't do it. So it has to be through a new loan. It has to be always assigned to a new loan. And it cannot cover more than 80% of the losses of that new loan. Okay.
Elena, what is the question?
So that's super elegant model. And I think the authorities would have wished they had your model when they were deciding on the issues. So there was a huge information asymmetry. So I guess that's the reason why they were relying on the banking system. And they were also worried about there was also a liquidity versus solvency issue. So in fact, I mean, in the data, you could think you have even more categories of firms. You had the ones which were solvent but illiquid as well. And so they were also wondering about, how to treat all these different categories of firms differently. So here, I don't know if you can speak to the liquidity issues versus the solvency issue in your theory.
I mean, in the theory, you do have some firms that are insolvent and illiquid clearly, and then you fund them. Here, so in this case, I guess whoever is insolvent here is liquidated. So in that sense, the model is very efficient because it liquidates the insolvents. My impression, though, is that in practice, and maybe I don't know if you can share this, is that it was a time where no one was really worried about, oh, if you get credit but you were insolvent. It was more like, I don't know if they were trying that much to make that distinction, because also it was probably impossible to know who is insolvent or illiquid. But definitely, I mean, we don't have this in this model, no, but if you had a model where you already had incentives to fund insolvent firms, then this becomes really bad, right? So yeah, it's.
Last question, Linda. No.
And let me just add the information asymmetries. I think that's something to think about also. It's like, how would the government do better without knowing productivities than what the planner actually does knowing productivities? This is something we could check.
So I just wanted to note that the International Banking Research Network has been looking at these government guarantees of bank loans. And part of the motivation there was that a lot of the banking literature studies that look at this just say, has there been an extension of credit?
Yeah.
And so some studies also think a little bit about the zombie firms. And I really, really like how elegant your model is and kind of pulling some of these issues together. One thing might be really interesting to do is go a little bit more dynamic. So if the government problem also includes the fiscal constraint,
yes,
and the cost of this program, which, is balanced against some of these efficiency dynamics going forward, it would be interesting to see kind of on net.
Yes.
And how do you parameterize the amount of the subsidy?
Yes. I think this is something that is missing here, which is how costly is this for the government? And maybe if we think of that, could that even rationalize while we do this credit guarantees program? Maybe it's better to pay in the future, pay in expectation. I think that's right on. And yeah, I think one insight from this that we didn't expect before we wrote the paper is that the margin that you really want to look at is the interest rate for these loans, which the literature hasn't been looking at. So it was something we learned from the theory that we want to, that's what determines the split of the surplus.
Thank you very
Thank
much,
you.
Victoria. And now Anusha is going to present.
Okay, so should I start? All right, well, thank you so much for inviting me to present at this wonderful conference. It's been an absolute pleasure to be here in beautiful Stockholm and with such talented women economists. So thank you for putting this on. Let me get the, yeah, here we go. So this is a paper, and I think Victoria's paper really sets up our paper very nicely because it is another paper on forbearance. And I'd like to flag that this is a 3-woman co-authored paper and not quite 4 like Maria Sunta. But so Lakshita Jain is a former graduate student. And the reason I still have UNC as her affiliation is because she's gone over to the dark side and now the exodus of PhD students into the tech sector and works for Meta. And so we can't really put Meta up here. And Nirupama Kulkarni, who is at the Reserve Bank of India. And some of you here in the audience are also, Georgia is working with her. So this is a paper on regulatory forbearance, and in a setting where the banking sector is predominated by government-owned banks, and then we're looking at what happens to zombie lending in this context. So a little bit of background is that if we take a step back and think about what goes on in lending relationships, is that firms sometimes do not repay their debt on time. And at this point, the lender, the banks must judge if this is due to illiquidity problems or due to solvency problems. And if it is an illiquidity problem, then the correct decision is to provide some forbearance to allow the firm to continue operations. But if it is a solvency problem, the implication is that we should really be liquidating or shutting down these firms or projects. Now, while banks have to make this judgment, incorrect decisions can cause either excessive liquidations or excessive continuations. Both are costly, and ex ante can introduce distortions. So our paper really asks two questions, which is how do government-owned banks make this choice relative to private banks, and why? And what are the consequences? So that's what we're going to be looking at in this paper. And as Victoria's paper just showed an example of forbearance during the COVID crisis, and countries around the world implemented these forbearance policies for both households and firms during COVID. How we sort of define regulatory forbearance is loan concessions or temporary repayment relief. And Victoria talked about loan guarantees to alleviate, in our context, liquidity stresses that borrowers can face during financial crises or special economic or legal circumstances. So the pandemic is a special economic circumstance. So whenever we think about forbearance, there are dueling incentives. All right, so the first is that as a risk management tool, it allows viable but solvent firms that are experiencing temporary liquidity stresses or problems to continue operations, versus if it becomes a tool to shield non-performing assets, this could lead to a failure by banks to appropriately provision for and manage credit risk on their portfolio. So this is really the tension that any sort of forbearance policy introduces. And so what we're going to be doing is to look at the credit allocative efficiency impact. So how is the allocative efficiency of credit impacted by a specific asset quality forbearance measure that was enacted by the Reserve Bank of India, not during the COVID crisis, but the global financial crisis. And so we have sort of, this longer period that we can do this evaluation looking at these, essentially it was asset risk reclassification, or what's known as asset quality forbearance, which I will talk about in a second. So the identification is facilitated by two things. The first is that we're operating in a predominantly government-owned banking system. And when the forbearance policy was implemented, it was under the guise of there is this exogenous shock of the global financial crisis. Global trade has shut down, and now there are firms that are not getting their receivables and then are having trouble repaying loans. So this is this exogenously dictated timing of the policy during the global financial crisis. Now, what the policy specifically allowed for was temporarily lowered capital provisioning requirements. So this allowed banks to alter the risk weights that were attached to loans that were said to be under liquidity stress. And then you'll see why I'm saying quotes in a second. But also what it allowed banks to do was to hide true asset quality. All right. So let me just dive right in and talk about what this asset quality forbearance actually entailed. It was called the RBI's special regulatory treatment that altered the asset risk classification. So before the pandemic, you had loans that were in good standing. They were called standard loans. And they had, depending on the industry they were in, they had a capital provisioning rate of 0.25% to 1%. Okay, so now let's say that a firm failed to make timely payments, and this non-performing asset duration was less than 12 months. So immediately you went into a substandard category, and the provisioning requirement increased to 10%. And the longer, so you see, you're going from 0.25 to 1% to having a capital provisioning of 10%. And if it continued for more than a year, then you entered into the doubtful category. And depending on whether it is from 1 to 2 years, 2 to 4 years, or greater than 4 years, the capital provisioning requirements went from 10 to 20 to 30, and then to 100%. And then, you know, after beyond that, you were considered a loss asset and it had to have 100% capital provisioning requirement. Now, what did the policy do? If a bank could say that certain loans were under liquidity stress, right? So they were having liquidity problems. This allowed the RBI allowed the banks to reclassify these loans in a new category of assets called restructured assets. So you have a firm that's not repaying on time, and instead of having to jump to 10% or beyond, could retain its standard classification. All right, so I can see all the bankers in the room that are shaking. This is like a sort of a situation that's ripe for regulatory arbitrage, right? Because it's precisely because how do you tell what's a liquidity problem, what is a solvency problem? So essentially, this was the policy that was put into place. And so what we're going to do in this paper is to focus in on this government-owned, this margin of government-owned versus private-owned banks in this setting to examine how regulatory forbearance can exacerbate the misallocation of credit. And I think there are lessons to be learned in terms of persistence, in terms of sticky matches, and so on, that can appear in terms of the allocative efficiency of credit. Now, we comb through hundreds of these policy documents looking for, is there a definition of liquidity stress in any of these government circulars? But it was just very ambiguously, loosely worded policy that gave the banks the discretion to lower these provisioning requirements that I just showed you for loans under temporary liquidity stress. And what we show is that this reduced loan loss provisioning essentially facilitated regulatory arbitrage by banks, which was facilitated through this asset risk reclassification. And our suggestion is that this forbearance functioned as an implicit, so it's not a direct guarantee, but it was an implicit subsidy that facilitated the buildup of stressed assets in the banking system. So before the crisis, India had one of the lowest NPA ratios in the G20 and amongst its emerging market peers. And after this policy was put into place, India had one of the highest NPA ratios, and this issue of both, the sovereign balance sheet as well as the corporate bank balance sheets as well as the sovereign's balance sheets sort of play a role. And Viral Acharya has talked about forbearance as a form of fiscal dominance because it allows, in the context of government-owned banks, allowed the sovereign to postpone the costly recapitalization of these banks, because if it's a government-owned bank, that's going to go directly on the sovereign's balance sheet, right? And so this can, forbearance and allowing banks to do this sort of reclassification functioned as an implicit subsidy. So this is the timeline of the policy announcements, which is that it was in August of 2008 that this regulatory treatment was announced following forbearance. And then, a lot of us in this room know Raghu Rajan. And so when he took over as governor and saw what was going on, he said, hang on, you can't do this, right? And so on the 30th of May, 2013, he sort of announced that there's got to be, you have to go asset by asset and sort of basically let us know if this is a solvent asset or is it a non-performing asset. And then we're going to have to appropriately do capital provisioning. And so the announcement of the withdrawal of forbearance, but they had to give banks some time to do this, which was going to be beginning April 1, 2015. And then there are a bunch of others. So that's really, there's a pre-period, there's the regulatory forbearance period, and we also have a regulatory forbearance retraction period, right? So we can see that when regulatory forbearance is withdrawn, do we see the allocative efficiency of credit going back up, or what happens to it? We had to stop in 2016 for a couple of reasons. The first is that India sort of implemented this massive demonetization effort. And so that really confounds a lot of what's going on. And then there was also the introduction of the insolvency and bankruptcy code, which was designed to facilitate firms that were insolvent to actually be liquidated. So that's why we sort of stopped this at about 2016. There's other stuff that Viral did, which was then again thrown out by the courts. All right. So this is kind of fun when you discuss a paper on India because we know the cast of characters. So the results in a nutshell are as follows, which is we have this hidden asset ratio, right? Which is now assets that are in this restructured category. We don't know if they're illiquid or insolvent, but they have this lower the capital provisioning. So we have this hidden assets ratio, which is the ratio of these restructured assets relative to distressed assets, right? And what we see is that, so you would expect that if banks are doing regulatory arbitrage, they're going to be moving assets out of the NPA category, or rather than going into the NPA category, they're going to be going into the restructured asset category. And so we can look at how government banks versus private banks behaved during this period. So this is the implementation of forbearance, and this is the asset quality review and withdrawal announcement. And so what you can see is that before the, right after the implementation of forbearance, you see that government banks sort of increase their restructured asset ratio a lot, and relative to private banks. And after the withdrawal, you see that this restructured asset ratio starts to come down. Okay, and if we look at the counterpart, which is the NPA ratio, the non-performing asset ratio, you see that actually before the announcement of forbearance, private firms actually had more NPAs than government-owned firms. But then after the announcement of forbearance, you're kind of seeing that the government NPA ratio, government-owned bank NPA ratios, remains relatively flat. And then after the announcement of forbearance, the net non-performing asset ratio really takes off, right? So this is essentially what is going on. And so the results in a nutshell are forbearance now implies distress later. And what we're going to do is to use a triple difference in difference effect to look at what happens to the lending as a function of whether firms are, we're sort of calling them zombie firms, but really we could see them as firms that are weak somehow, right? So they could be either low liquidity, low solvency, zombie, getting preferential credit. There are many different ways in which we can categorize this subset of firms that are really sort of the weaker firms. And what happens after regulatory forbearance, conditioning on whether the lender is a government bank or a private bank. So these are the three margins are government versus private, zombie versus healthy, and the pre-forbearance versus post-forbearance announcement, as well as the third phase is the retraction. So a preview of the findings is that government-owned banks were conduits of zombie lending by evergreening existing bad loans to hide losses. The increase in zombie lending was about 25%. And the surprising finding is that there is no decline after the retraction. So this is where we're arguing for this sticky match between the government-owned banks and the weaker firms, and it's hard to break the match even after the withdrawal of the forbearance has been retracted. Now, what we see in terms of the allocation of credit is that credit was reallocated from healthy firms to the weakest firms, and once we control for demand side factors, zombie lending by government banks crowded out more productive lending. So these are the real consequences of this forbearance policy, especially in industries and bank portfolios with high proportions of zombies. Okay, so when you are trying to evergreen and lend to these zombie firms, what we see is that you're crowding out the more healthy credit to the more healthy firms or the healthier firms. These links, as I mentioned, between government banks and inefficient firms persist following forbearance withdrawal, signaling the possibly irreversible lending distortions and sticky matches between government banks and weak firms. So this is a cautionary tale about the potentially long-lasting misallocation effects of temporary forbearance measures. So the bottom line is government-owned banks appear to be extra kind to their tardy borrowers. And the forbearance policy has two effects. It lets the weaker firms operate for too long and lowers the credit flows to the healthy firms. And finally, there are real consequences. So I'm not going to get into the existing literature here. I just want to tell you briefly about the data, which is that at the borrower level, we have a sample of non-financial borrowers from Prowess. And we can assign these firms to their lead bankers. So we know who their lead bankers are. And then banking secrecy laws in India prevent banks from releasing information about who their clients are, but they can report their non-performing assets, assets in good standing, etc., at an aggregated level. And the RBI sort of reports this in this publicly available data, which is aggregated at the bank level. So we take this forensic approach, which is looking at the firms and seeing what is the lead banker that they have, and then linking it to the bank level data that the RBI is providing, which tells us about something about gross and restructured assets and non-performing assets based on the ownership of banks. And just to give you an idea, banks in 2016, there are 27 government-owned banks, 21 private, 49 foreign, and the market structure is really quite striking, that the market share of government-owned banks is 70%, private banks is 23%, and foreign banks is only 7%. And we have a bunch of different measures. For a zombie firm is one that receives subsidized credit compared to the most creditworthy firms in the economy. Our measure is the average interest rate being less than the prime lending rate of the safest bank, plus the debt to asset ratio of 0.15%. There's alternative measures that, you know, incorporate the interest coverage ratio and so on. And then we can also look at other dimensions of firm health, which is low solvency and low liquidity firms. So let's look at the, let me show you this baseline specification, which is looking at the lending to a firm J at a time t+1. We have, you know, the compositional controls like the bank fixed effects, time fixed effects, firm fixed effects. But really what we're interested in is this triple interaction effect between, you know, conditioning on bank ownerships, the health of the firm, and the regulatory forbearance. And this is 2 periods. K=1 is the forbearance period. K=2 is when forbearance is withdrawn. So we can really look at both. So let me just show you what happens here, which is with government banks and zombie lending, is that zombie lending increases by 26% for government banks relative to private banks. And this is what we see here. And this is sort of statistically significant. And if you look at the specification, number 4, in the retraction period, this is positive and not significant, which basically means that, you know, I would have expected this to be negative and significant if that was our prior, that once, you know, you withdraw forbearance, this zombie lending is going to go down, but it doesn't. It sort of remains stable. So there's no reversal during the retraction period. And so in the paper, we sort of unpack this triple difference effect, which is looking at government banks post versus pre. Then you look at private banks post versus pre, and then you do the triple difference, which works out to about 26%. Okay, the credit, I'm really literally out of time, but then we look at 2 main channels of credit reallocation, which is the bank lending channel and the demand channel. And so I already mentioned to you that if you had higher fractions, banks with higher fractions of zombie firms in their portfolios crowded out lending to their more productive clients, and also in industries, that's the indirect demand channel via industries. So I just want to end with this, which is related to what this means for the fiscal situation, right? So, so the ex-governor of the RBI, Urjit Patel, who used to be at the IMF, it basically has talked about banking sector fiscalization, which is that as successive governments have found their capacity for further fiscal expansion to become more and more constrained, it has used banks to fire up and pump prime the economy, hence the term banking sector fiscalization. And then Viral has talked about fiscal dominance in default disclosure norms, because the disclosure would increase the capital requirement of public sector banks and would therefore require a budgetary allocation from the government. So, you know, we're just left with this basic question of why governments do this. It could be disclosure aversion, because governments tend to bury problems. It could be effort aversion, because dealing with bad loans requires efforts. Incentive issues, because to unearth these problems are absent, and so on. So let me just sort of end here, that we really showed that the forbearance measures provided an incentive to hide true asset quality, and the our sort of view is that the buildup of stressed assets in the system is a byproduct of accounting subterfuge. So thank you, and sorry I took like a minute more. Oh, I'll just stay up there. Yeah.
And now Medina will discuss the paper.
Thank you. Well, thank you very much for inviting me to discuss Anusha's paper. And thank you again for the organizers for inviting me to this wonderful conference. It has been really great 2 days. So the unholy trinity. I like the joke that Anusha makes with a title. What is the research question of this paper? What is the impact of forbearance on the allocative efficiency of credit? And of course, we know from the literature that there are two different sides that people see forbearance. There is also the bright side, where papers support the idea that forbearance can help general solvent firms to overcome temporary liquidity stress. But there is also papers that support the dark side of forbearance. And in this case, banks use forbearance measure to hide non-performing assets and to keep zombie firms alive. So in this paper, they are using the reform in India that Anusha described in very much detail. So let me just go through quickly the key points that I guess people need to remember from the forbearance measures that were adopted in India in 2008. So it was the program allowed banks to choose whether they would classify a loan as a loan that it's under temporary crisis-induced liquidity stress. And then banks had the option not to automatically classify the loans as risky ones in case they missed payments. Of course, they argue that the timing of this policy was exogenous, and then they are constructing a firm bank panel dataset that required a lot of work because they had to hand collect the information that created the link. It was not already a built-in panel. So great work on the data collection. And then they're exploring the heterogeneity on the banks. There are many banks that are government-owned and other banks that are private-owned. So they're exploring this heterogeneity with three interaction terms: pre-post the forbearance policy, government-owned banks versus private, and then zombie versus healthy firms. What do they find? First, they find that banks actually use this policy to postpone the recognition of troubled assets. And perhaps that's an indication of a regulatory arbitrage that banks did. In particular, they show that government-owned banks, they increased lending to what they classify as zombie firms relative to private banks. They also show that zombie lending crowded out lending to healthy firms. And then they hint on real effects of forbearance because these zombie firms use the money to pay its wages and not to invest. And then they're arguing that there are long-lasting effects of these policies. Why should you read it? First, you should read it because it's a really important paper. And as Veronica also said, there are different countries that adopted similar policies during the COVID period. So it has become one of the usual tools in the policy debate. The debate around zombie firms is also very important because it affects both the corporate sector, but also the banking sector. So overall, the economy in a more general way. And of course, it affects a lot the possibility of future recapitalization of the banks, because then you can think that these matches between bank and firms, they are sticky. So even if you recapitalize the banks, then it may not solve the problem. It's a clean exercise with a clear contribution. I like the execution of the work, and it has a significant data collection effort, policy insights, so everything is in the paper. So whatever I say, I would just want Anusha to think my comments as more as clarification questions, because this is already a quite polished paper, so it's mainly things that were not clear to me while I was reading them. So sample selection, one of the key things that had to do with the way that they constructed the sample is that the firms voluntarily disclose the banks. It's not a requirement for firms actually to disclose the banks. And to me, that can perhaps create a sample selection issue. So who are these firms that they chose to disclose their bank versus the other ones? Do you expect this choice to create an upward or a downward bias in your results? What is the total share of loans that you have in your final sample relative to the total amount of loans that are reported in the bank? So can we see that as a representative sample of the total lending in India, or is it the specific share of the firms? Could these results be driven by the entry or the exit of the firms from the final sample? Is there an incentive for the firms to disclose or to avoid disclosing this information? So what is actually driving this selection? How often do you see firms dropping in or out the sample, or you have something that is continuous observations? Can firms choose to report to one bank versus the other, or they have to report all banks that they're borrowing in case they actually are in the sample? The second set of questions that I have are related to the definition of the zombie firms. So in the baseline specification, you classify as zombie the firms that receive subsidized credit, which means that they have relatively lower interest rate compared to the other firms, and they have a high leverage. But these two can also be driven by other firm characteristics. So it can be driven by the industry that they belong to, the age, the size of the firm, and all of these characteristics of the firm may actually drive the interest rate to be low and at the same time their leverage to be high. So I was wondering what is perhaps the variation within the same industry size, age group of firms that you classify as zombie and healthy. To me, a bank has an incentive to evergreen a loan if there is a long-lasting relationship between the firm and the bank. Can you say something between how long this relationship is for zombie and healthy firms? Is this classification of zombie time varying, or if you are once classified as zombie, then you stay a zombie forever? How do zombie firms vary relative to their respective profitability, perhaps defaults or stock returns? You mentioned that there are several public firms in your sample, so perhaps you can see whether there is a volatility in their stock price in case these are actually bad firms. Causality. So it's a paper that really tries to make a causal statement here. And the causal statement that Anusha and her co-authors are making is that government-owned banks increased lending to zombie firms, but not only that, it also crowded out healthy firms' access to lending. Of course, they check the parallel trends, so I trust that everything is clean here. But the other question that always comes up in these empirical banking papers is the demand versus supply. And I guess you don't have applications, so you don't know whether healthy firms are going to government-owned banks and they're getting rejected, but perhaps you can look on healthy firms switching banks. So in this case, you would see that a healthy firm switches a bank and goes to a private bank, and that could be an indication of demand pressure as well. But I think that this is actually important overall in order to understand the results in the way. How do you want us to see that? Do you want us to see that as a misallocation of credit, or a subsidized, or that government-owned banks subsidize credit for weaker borrowers? And I think that this is important because it will change completely the interpretation of the results. So I have a few other unanswered questions. So I can, since Katarina is still generous with time, I can go through them. Differences across banks. Do private banks offer higher interest rates relative to government-owned banks? And if that's the case, then I guess more firms would be classified as zombie in government-owned banks by definition because they would offer lower interest rates. Moral hazard. Do firms have an incentive to delay their payments or after the adoption of the policy, or it's that doesn't create an incentive for the firms? Geographic variation. I think you were really silent on that. And in my mind, India is a huge country that you can do a lot with geographical variation. I guess you can explore that more. I mean, I'm curious to see why you haven't done that. I'm sure that you have thought about it, but there should be a good reason for that. Same for industry, not to zero. Industry variation and bank specialization again. What explains the firm-bank match? Multiple firm-bank relationship, we already talked about that, and perhaps bank switches. But I think the key point here is what is this unholy trinity? And to me, I really wanted to see what you think that it's the unholy part in this whole example. We don't trust these forbearance policies at all. They always create the regulatory arbitrage, an incentive for all of them. We don't trust government-owned banks. These are the ones that are always taking the advantage. Is this what we should see? Is it the creation of the zombie firms that is causing these effects? And overall, something that I mentioned during the presentation, I think it's important to understand whether this creates a misallocation of credit or whether government-owned banks during that period actually helped and supported weaker firms instead of created this misallocation. But overall, thank you very much. Great paper, I learned a lot. And again, a big thank you to the organizers. I really hope that this will become a tradition. Thanks.
So Anusha, do you want to take a few minutes?
Yeah. I think the comments, thank you so much. They're just extremely detailed, and I very much appreciate them. And so I'll just respond to a few things, and then I'd love to hear if there are any questions. So one thing that I wanted to say is, yes, we can actually, all the data things, clarification questions that you asked for, we can definitely sort of beef up that portion of the paper. And, the firms do disclose their lenders on a voluntary basis. We didn't have time to get into it, but we actually have all the banks that, if a firm has multiple lenders, we have information on all the banks. So, we can sort of randomize and look at whether the way that we're picking the lead banker is introducing any sort of selection, but that's definitely something we can do. In terms of the zombie classification, again, there are multiple ways of doing this. People don't really agree on one definition of zombie. We've tried many different definitions, and I think we're going to look at the baseline, which is subsidized credit plus an interest coverage ratio of less than 2, we might land on that as our baseline. We did look at stock price responses. At a certain point, this paper was like 90 pages long. So then we had to sort of make some cuts, but we do see that when this forbearance policy is announced, that the weaker firms, their stock price actually falls. And so also in terms of causality, what we're claiming is plausible causality. We're not saying this is we're strictly establishing causality, but in additional tests, we do the type of quadramia controlling for the demand side to look at the impact of supply. And one result that might have got buried is that what we do find is that healthy firms switch to private banks. So we do find that the separating equilibrium emerges, which is government-owned banks with zombie firms or weaker firms, and then the private banks are the ones that are getting the better, the healthier borrowers. And so I would really say that is the unholy trinity, is the regulatory forbearance. It is the different incentives that government-owned firms face, primarily because it is this, disclosing these loans would have direct impact on the fiscal situation. And then you have this combination of these zombie borrowers and this persistence of these lending relationships. In terms of the final thing I'll say is, geographic variation. We looked at distance to regulator, and in order to sort of look at whether the geography actually plays a role, and we find that the further away you are from the regulator, that actually has an impact. But let me stop there.
So thank you very much. There is still time for 1 or 2 questions. And Hélène and Victor.
So no, just a quick reaction on, I mean, another thing to look at would be the political economy, like whether, you know, the different states and given their political, you know, voting pattern, there would be any correlation. That would be super interesting. But my comment was about something else. I wonder the persistence of the effect. Is it simply due to this kind of switching cost relationship lending? Or is it that, you know, the RBI didn't do the job, they just announced a reversal, but what did the supervisor do, I mean, to implement it? So did Raghu Rajan follow up, or did it just like leave it to the free will of the banks?
Yeah, maybe we collect a few questions.
Yeah.
Victoria?
Mine was more of a clarification. Maybe I missed something, but it seems like private banks also would have the incentives to do the same thing government banks were doing. So I was wondering, is it that the constraint is not binding, but the government is, or how do you view the government part?
So you can.
Okay, so yeah, absolutely, Ellen. You know, there is a political economy story lurking, and it's definitely something. But I think we're going to do that in another paper. And I've actually talked to Raghu about this, and so he sometimes gets upset with this paper because it sort of suggests that his policy didn't actually achieve anything. And I'm like, and he said, you know, it takes time, and so. So I think that's the RBI is the regulator and the supervisor. So they have the bank supervisors going up, and they did follow up, but it takes a really long time. And I think there is a political economy story that if some big oligarch is borrowing from a government-owned bank, there's still resistance to classify those loans as an NPA. So you know, all of that is happening. And Victoria, you're exactly right that this is really the crux of it, right? So private banks could also have entered into the restructured category, and we don't see that happening. So the question is why? And I think it does have to do with the fact that government-owned banks are a different sort of category, precisely because the sovereign, they have this implicit backing of the sovereign. And the fact that it's this fiscal dominance story that the sovereign can pressure the government banks to, you know, act as its handmaiden or whatever you want to call it.
1 second, the mic.
I am wondering whether the government wanted to lend to these bad borrowers, and then they came up with the forbearance not to make the government, the banks that they were controlling look too bad.
Yes, absolutely. Because there's also this, you know, we're talking about this as exogenous timing due to the GFC. There were a whole bunch of infrastructure loans that had been made before that were then not paying off. And so it was very convenient to say, oh, you know, the GFC and implement this policy. But it's, you know, you can look at the impact by industry and things like the infrastructure loans that were going to go bad. It was to kind of hide that.
So thank you very much.
Thank you.
And so I would like to invite Helen to join me, thanking everyone.
Yes, absolutely. I just wanted just 5 minutes to thank everyone for this fantastic conference. So thank you for everybody who has spoken, but I would especially like to thank the people of the Riksbank who have helped us a lot. And so here there's Lena, there's Joachim, and there's Clara, who have helped also with the mic and the slides. So that's really super kind of them. So we should really have a round of applause for them. Thanks a lot. And also, of course, the organizers, so Daria, Katerina, and Fiorella, that was, and the entire program committee who did a fantastic work, and that was a lot. And also to end, Lydia and Petra from CEPR, who have also been absolutely instrumental. Thanks a lot, and hopefully see you next year.